Down if you're talking about stocks. 2-year yields are getting a bid in Germany. Meanwhile, the euro continues to fall. We're going to be talking to Esther Reichelt of Commerce Bank shortly later in programming, whose team there thinks the euro is going to 114. All right, let's look at the futures picture. Again, just 30 seconds until these markets open, and it is a negative pointing market so far this morning. DAX is underperforming. Maybe the more cyclical sectors do worse today, down about 0.4%. CAC 40 not as bad, about 0.3%. We are going to get some China data coming out this week around midweek time, just before we're going to get the U.S. CPI report. So there's a few things that could upset us here, especially if you're thinking about the China-exposed European equities, if we do see more of a deflationary picture coming out of China. All right, we're just starting to get markets open. Let me take you to GMM and see what we got out on the board. FTSE 100 opening first out of the gate, as it always is. UK stocks, those are looking quite soggy this morning, down 0.1% and stacking up. There it goes, red, down about 0.2%. Spain's IBEX, similar situation here, down 0.25%. Now, keep in mind, we don't really have a lot of large cap earnings today, so nothing to really move things one way or the other. We don't really have any data today either. No macro news. We are going to have Hugh Pill speaking later from the BOE today. That's kind of the only macro-related thing, the only possible catalyst, at least as of this moment, unless we get some sort of surprise to really shake things up. So in the meantime, we're just kind of drifting lower. France just opened down 1/3%. Considering we had a soggy end of the week last week for U.S. equities, it's hard to see how we can really shake off that type of sentiment, considering we are squarely in the summer. We are in the second week of August when a lot of people are away from their desks. It doesn't mean we can't get volatility, because of course volumes do tend to be lower. All right, FTSE MIB, that just opened down 0.1%. So about 4 markets open in Europe at this moment, all of them pointing lower, not really seeing any green shoots at this moment. But again, we're lacking catalyst. Sovereign bonds, those are getting a bid, but we saw that in the US on Friday, the front end of the curve getting that bid, and that's what we're seeing in Europe. Okay, let me show you what some of the sectors are doing. Again, I should just emphasize, not a lot of catalyst today, not a lot of earnings. The only thing that is pointing higher is the banks, but barely. 0.01%. I actually wouldn't be surprised if this flashes red in just a moment, just to define me, because I just said that. Okay, stepping back, taking a bigger look, it looks like one of the worst performing sectors are basic resources. Not surprising, we're seeing iron ore tumbling. Goldman Sachs warning about that market, warning about China. So iron ore tumbling more than 1%. Basic resources sell off. Energy unable to sustain those gains from last week after the news from Saudi about more cuts. So we're seeing energy fall about 0.1%. Again, not huge moves here, but it is all negative. Autos, really cyclical things, really falling today. So again, without any catalyst, this is the idea you get of markets, that we're predisposed to move lower during an edgy summer month. We're predisposed to sell some of those cyclical sectors. Okay, so that's the stock story now that we have the markets open. Let's take a step back, though, and look at the overall markets. We're going to do that right now with Christine Aquino, who joins us from our Markets Today blog. Christine, we got to start with sterling. Last I looked, it was falling. It was weaker today after a really strong year. Sometimes I need to remind myself that it's the second best performing G10 currency versus the dollar this year. But what are strategists and traders saying? Can that kind of momentum maintain itself?
Well, Danny, looks like the consensus is increasingly no. The pound probably has had its best days behind it now, and that's largely due to expectations for the Bank of England. We did hear from the bank last week, essentially indicating that they may be nearing the end of their rate hiking cycle, though they may keep rates at this restrictive level for a little while. And so now we've seen a lot of bets saying that, look, the Bank of England probably only has one more rate hike left in its arsenal, so taking that rate to 5.5%. And then into 2024, we're also already starting to see bets for rate cuts. And at the moment, I think for 2024, the bets are for 50 basis points of rate cuts. And so essentially, the expectation is that any more rate hikes that the Bank of England delivers this year will immediately have to be reversed in 2024.
So if the pound is also seeing the best of its days past us, it also seems like same goes for junk bonds. We had Adam Whiteley on from Insight Investments earlier. Basically, I just flagged him the great performance of junk bonds. They have done really well, again, despite expectations, whether they were right or not, that the economy would turn.
Yeah, quite interesting data, because I think we did see a bit of a revival in that space, along with other riskier assets, because this whole idea of a soft landing really took hold once again in July, right? And so the idea is that maybe we're going to be able to avert a recession once again, because we are seeing inflation cooling as a whole. But I think now that we've seen more inputs, for instance, from the job market in the U.S. last year, really kind of still sending mixed pictures regarding inflation, and particularly that wage growth number really still quite unrelenting. And so I wouldn't be surprised if we get more calls, in addition to Michelle Baumann, calling for more rate hikes, just because it seems like the economy can handle it.
It's the double-edged sword of the soft landing narrative, right? Because you could say the economy is doing well, we're going at it okay, but then you can also say the economy is doing well, the Fed can hike more. On this point, I find interesting this lineup of strategists who have flipped their recession calls. JP Morgan is the latest. They did see a recession this year. They now say we're not going to see one, and next year we're not going to even get a recession. It'll be just more tepid growth. But it does feel that way, right? It feels like it is this strategic capitulation where the recession bets are either getting pushed out or completely undone.
Yeah, absolutely, Danny. I mean, I think I remember at the beginning of 2023, everyone was calling for essentially some kind of recession, maybe even as soon as the end of this year. But yeah, really, it seems like the economy has taken a turn for the better. And I would credit a lot of that to the consumers around the world. You know, we're certainly seeing the resilience holding out very much in the US, but even in the UK, where we are meant to still be in a cost of living crisis, we're still seeing that strength in the consumer, especially from the earnings slew that we saw last week, right? Like a lot of consumer-focused companies in the retail space still reporting that pricing power that they're able to wield. And so, yeah, I think like consumers holding up much, much better than expected, and therefore saving us all from a recession.
That's so true. Even when we have heard that consumers haven't done well, it feels like a one-off. Like Heineken didn't do well, but AB InBev did really well. The Heineken story felt like a one-off. Christine, just to bring it back around, because you're talking about the consumer in the UK, what's the latest with UK housing? Because we got some data on that front.
Absolutely, Danny. Our favorite topic on the Markets Today blog. And you look, it's still pointing to a downside for house prices all around. But at the same time, we're still seeing affordability issues, which kind of two sides of the spectrum here, really. So the latest reading that we're getting, of course, is that housing outside of London also becoming a lot more expensive. And so for anyone who's thinking, oh, maybe I'll save on housing, let me move out of London, that's becoming less of a viable option. And then, of course, we're getting data from Halifax as well this morning showing that house prices continuing to fall, not as much as the nationwide figures showed last week, which was the biggest decline in since 2009, but still continued decline for house prices. And so, yeah, I think it is very much still, on the one hand, house owners not really getting a great deal for their homes, as you have experienced yourself, Danny, but also home buyers are trying to get on the property ladder, also having affordability issues.
Yes, and honestly, that is more important than my own housing woes, even though I love to complain about it. Christine, thank you so much. Christine Aquino from our Markets Today blog. And you can get more from Christine and the team on the front pages of the Bloomberg UK website or by typing TLiveGo on the terminal. All right, let's get back to some of the individual stocks on the move with Joe Easton, because Joe, you flagged some of these on your stocks to watch. I mean, we're seeing some pretty significant moves here.
Absolutely, Danny. So we're going to look at the renewable energy stocks first. So Siemens Energy, that one was opening down around 5% in early trading. We've brought up Siemens AG as well, which still owns around a third of this stock, and that one's falling around 1% over on the Xetra exchange. Then we brought up Vestas over in Denmark, mentioned in Stock Swatch, potentially a read across through for that one. That's down 1.5%. And Nordics, which is also in Germany, like Siemens Energy, down around 0.5%. Now, this comes as Siemens Energy, of course, cuts its guidance for the year, quadruples its loss expectation to around 4.5 billion euros. We're going to flip over and show Siemens Energy a bit later on, I believe, just been told. But also shout out for that pun that the producers put on there, Siemens headwinds. Okay, so we're going to bring up the Siemens Energy price according to the producer. Here we go. There we go. Down 3%, Siemens Energy. So we did get that drop as expected for that company there. That one, as they have problems in their wind business that they recently took private. Meanwhile, we're going to flip over and have a look at these satellite stocks. OHB, Bloomberg exclusive, that one is being taken over at around a 30% premium. That one is up 33.5% over on the German exchange. So getting a real boost there, taken private alongside the founding members of the family, doing a deal with KKR for that one. Not seen too much read across in the other peers, SES and Eutelsat, if I'm pronouncing that right, both listed in France, pretty much unchanged. Also brought up IAG because on Saturday we got news that British Airways is giving its staff a 13% pay rise, something that they've been battling for a long time with the unions there. That one coming down slightly, maybe priced in, given the fact that that went on for a number of years, as I say. But IAG coming down a bit, the British Airways owner. Finally, we're going to look at some ratings changes as usual. We got some broker moves. Rolls-Royce, as we had in Stocks to Watch, upgraded JP Morgan. They've ended their around a year and a half, recommending clients sell that. They go neutral on the stock. No longer any analyst rating sell on Rolls-Royce, and that one is up around 0.1%. It was up a lot last week, so that's probably priced in there. K&S, now this one is upgraded at Berenberg. There's been loads of profit warnings in the chemical space, so they're saying that this is all now factored into the share price and think that people should be buying that one. That's the chemicals firm listed in Germany. Meanwhile, Teleperformance, this is the telecommunications and call center company, so they outsource call centers, downgraded over at Goldman Sachs, who think that the profit warnings from them probably not taking into account all the negativity with companies cutting back on some of their services contracts due to the cost of living and economy concerns. Now, Card Factory, up 17% in London. This is all off a statement that was so short, it was about 2 sentences. All they said is that trading is better than expected and they expect guidance to be beaten for the full year. And that one is rocketing, up 16% now. It's a smaller company, but a high street bellwether. Also a reminder for me that it's my missus's birthday coming up, so I need to get a card. But that one's up around 16% at the moment, Danny.
Wait, when did you say it was, Joe? Next week?
That's Sunday.
All right. You got some time, but get on that, Joe. Get on that. Joe Easton from our equities team. Thank you so much. All right, let's take a look at what we're going to be watching out for this week besides Joe's partner's birthday on Sunday. Of course, the big event of the week on Tuesday. We're going to get the ECB releasing its consumer expectations survey. On Wednesday, we're going to get China's CPI and PPI. Will we see deflation that's likely to be exported to the rest of the world? Later in the day, we're also going to be getting Disney earnings. It'll be interesting to see how the writer's strike and actor strike, for example, manifests itself in Disney. Then on Thursday, it's the big one. It's U.S. CPI. Now, the prior month's report showed a rise of 3% from a year ago, which was the smallest increase in more than 2 years. Will that pattern continue? Then at the end of the week, more data. We're going to get UK GDP and U.S. PPI. Now, coming up, a hawkish tone. The Fed's Michelle Baumann splits from other Fed officials, warning that more rate hikes will likely be needed. We're going to have the details and the market response for you next. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg.
It's the job report that has something for everybody.
I think this is an in-line payrolls report.
Pretty strong report.
In line with market consensus, but also in line with Fed wishes.
Gradual labor market normalization.
Our view is the Fed is done.
The Fed can be done. They can wait.
We may still be looking at either a September rate hike or another rate hike before the end of the year.
The hawks and the Fed are really going to focus in on the wage growth.
We can accommodate this 4% wage growth.
They're going to argue the labor market is still strong. We're going to need to move more.
Feels like the soft landing camp is definitely winning out here.
The marketplace favors at the margin the softer landing interpretation as of now.
So there you go, a lot of different opinions from that U.S. employment data that came out on Friday that did show softer job growth than expected, but at the same time, wages that were stronger than expected. It was truly a choose-your-own adventure of U.S. data. Joining us now is Esther Reichelt, FX strategist at Commerce Bank. Esther, how have you read into the most recent data? Can you even get a strong direction for this American dollar, for the greenback, based on the most recent data we've seen, when it is, again, you can kind of just pick apart anything you want to see?
Absolutely. However, the US dollar reaction with the US dollar trending lower shows us that there was a lot of US dollar optimism priced in. So the market focused more on the negative aspects of the US labor market report. However, you have to point out, of course, in general, like you see a moderation in the NFP numbers. So this all points towards this soft landing scenario. However, you have to keep in mind, it's only just a small margin from a soft landing to maybe a no landing. Right now, US dollar is clearly benefiting of this hope that this will be sufficient to bring down inflation while not leading to a severe recession. But whether this will really play out as expected, this will only be, we will only see this over the next few months, maybe only beginning of next year.
So what happens then? What happens at the beginning of next month once that runs out of steam, Esther?
Well, I think, like right now for base effects and things like that, inflation will come down. However, it is, in my opinion, totally unclear yet whether what the central banks have done so far will be sufficient to bring down inflation on a to bring back inflation to 2% and keep it there on a sustainable basis. And that is a risk that so far is not priced into the markets right now. Like everybody is, or what's moving the market is whether central banks have to do more or whether it's sufficient. We've seen this not only in US dollar, for example, also in pound sterling. So this is a mover right now. When will central banks reach their terminal rate? But whether this will be sufficient, that will be, in my opinion, be the next big mover of the FX market.
So just to be clear, so we get to the end of the year, is the idea then that by that point we've already hiked a lot and the economy turns, or that's the point that we realize the Fed has not done enough? We have, for example, the fiscal policy tailwind for inflation, and we get more hikes? Is that kind of the idea?
Well, I think whether we need more hikes will actually play out over the next few weeks. I mean, of course, the CPI report we are seeing this week will be very important. I think that's something the Fed wants to decide on when updating their new forecast or their forecast in September. So this is, as I said, right now, the focus is clearly on when will we reach the terminal rate. However, like whether this will really be sufficient, that's for next year. And I mean, of course, that might be required some fine tuning. That's nothing everybody is expecting right now. But the big uncertainty here, right, and I have to stress this, is we simply do not yet know, and the central banks also don't yet know, whether this will be sufficient for next year, like whether we really will anchoring inflation at the target rate. And that's something, like that will only play out over next year.
Yeah, I mean, Esther, it does seem that in just general, more folks feel confident about what next year will look like than the rest of this year, which makes things particularly tricky on that front.
Exactly,
walk me through your euro dollar call, because this is one that you've reaffirmed at the end of last week, because you have expected, again, maybe not for this year, but next year to see a stronger euro.
Yes, exactly. And I mean, of course, over the last few weeks, it didn't look like it. And maybe some had expected that we take down our euro dollar forecast. But what we've seen so far is actually not yet, like it's not what we base our euro bullish call on. So right now, US dollar is remaining stronger. What is clearly the topic for the market right now is this economic divergence, like better economic data from the US, the hope for a soft landing scenario in the US, while the economy really seems to cool in the Eurozone. However, next year, we expect, like inflation picture in the Eurozone is still, more detrimental. So the ECB might be less inclined to cut interest rates. And on the other hand, the United States, we do expect that the economy will cool later than we expected, maybe because the economy is much more resilient, as we are seeing the data right now. But towards at the beginning of next year, we will see a decline in the economic data, and we expect rate cuts of the Fed, because they have the dual mandate. They also have to look at the labor market. However, we do not expect that from the ECB, because they are simply focused on these inflation numbers. And as I said, it's not yet clear whether what we've seen so far will be sufficient to bring down inflation to 2% on a sustainable basis. Yeah. So this might result in a monetary policy divergence that's supporting the euro.
And Esther, just quickly here, because we're almost out of time, what brings to an end the period of economic weakness in Europe? What are you looking for to turn that around?
Well, I think basically it's time, the downturn will also be less than many had expected, and we expect them to pick up next year. It's different than in the United States because we had the special effect of stronger effects of the Ukraine war. And it's basically time. I mean, we've seen it's largely a German factor, and other countries are picking up much better. So this should already point towards a rather a soft decline that ends then towards the end of next year or something, towards the end of this year. So, yeah.
Got it. Esther, as always, wonderful to get your thoughts. Esther Reichelt there, FX strategist at Commerzbank. Now, coming up, Saudi Aramco follows the other oil majors and boosts its dividends payout. We're going to discuss their second quarter results next. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Market Today, 25 minutes into your European trading day. Still some losses, but not as bad as we saw during the future session. All right, let's get more on Saudi Aramco's results that broke in the past hour. A lower profit, but a dividend. Let's bring in Bloomberg's Middle East energy markets reporter, Anthony DePaula in Dubai. Anthony, what do you make of the numbers?
Yeah, good morning. As you said, the profit is down, but we are getting a higher dividend. So that is on trend with what we've seen from a lot of the other oil producers so far this quarter. The oil majors, the international oil majors, we saw them with profits coming down, but the payouts to the shareholders coming up via dividends, via buybacks. Here with Saudi Aramco, of course, they're going to be hurt compared with last year, which was a huge year for oil prices. We saw those prices spiking after the Russian invasion of Ukraine. They've come down just recently, just last week, we zeroed out all the losses in oil for this year because they had come down so much this year. But it's those production cuts that OPEC Plus, led by Saudi Arabia, is really using to stabilize the markets. We have seen the oil prices come back up, but the story for the first half is lower prices, lower production for Saudi Aramco. So that brings down the overall net income. But we are seeing the regular dividend increase by about 4%, and then they're adding on a special performance-linked dividend. So that's going to increase the payout by more than half compared with the same quarter last year. And that is based on 2022 earnings and the first half of this year. What's important to note, a big figure for Saudi Aramco is the free cash flow. That's the amount of money that they have to cover that dividend after they've made all their investments. So on a second quarter basis, they're not quite covering that dividend payout, but over the first half, that first half free cash flow would cover that payout, Danny.
Yeah, also looking, I mean, just interesting to say that dividend won't impact their M&A or their investments, and China demand held up stronger than expected, according to the CEO. Anthony, thank you so much for that. That's Bloomberg's Middle East energy markets reporter, Anthony DePaula. This is Bloomberg.
go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 30 minutes into European trading day. Here are the top stories. It's a tepid start to the week for markets as Fed officials debate further rate hikes ahead of this week's inflation report. Governor Michelle Baumann warns additional increases may be needed. Aramco raises its payout to shareholders by more than half. The world's biggest oil exporter announces a performance-linked dividend despite a drop in quarterly profit. Plus, Israeli Prime Minister Benjamin Netanyahu tells Bloomberg exclusively he will not pursue the entire judicial overhaul originally planned by his government.
I don't think we should move from one extreme where we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes.
All right, so we're here 30 minutes into European trading day. Not a great start, but I have to say the futures picture was way, way, way worse. So we are coming off that a little bit. Maybe we're picking up the impulse from the U.S. session that's doing better, but just recall that on Friday, we saw U.S. stocks decline for the longest daily losing streak for about 3 months. So it makes sense that Europe would have to catch down to that to some degree. FTSE 100 underperforming the most. Despite a weaker pound, that's not giving us any lift to European stocks. All right, let's check in on your sectors. Basic resources, the worst performing sector. Not too surprising, given that oil slightly lower, given that iron ore was down as much as 1% at one moment. It's come back. You are seeing a lot of the kind of cyclical sectors doing unwell. So that's like construction materials, travel and leisure, autos. Okay, utilities is in there. That's not a cyclical sector. That is squarely with the safe havens. Technology, healthcare, media, banks, all of those are at the top of the pile. All right, let's dig into this and get some of the individual stocks that are on the move. Joe Easton has that for us. Joe, what you got?
So these are some of the biggest decliners then around half an hour into trade, Danny. So Arubis, this is a copper smelting company working in the copper and also the steel industry. Got a bit of a negative update out today. Earnings not as strong as expected, partly due to some of the uncertainty around China, the obvious driver there. That one's dropping around 6%, the worst performer on the Stock 600 this morning. Meanwhile, Taylor Wimpey, UK home builders, in focus once again. We got more data out showing that prices are declining in the UK very slightly in terms of some of the residential markets there. Daimler Truck, the very sad news of the CFO's passing, so that one is down 1%, some uncertainty on that one there. And also Teleperformance downgraded over at Goldman Sachs. This is the telephone call center company. Did have a short seller report out on that one not long ago, and that continues to weigh on that one. Goldman not liking that stock this morning. Then in terms of some of the gainers, We're going to bring up a few of those as well. Scout 24, that's the best performing stock in Europe today in terms of the stock 600. They have had some earnings out. They are a classified company. They do a similar thing to Auto Trader here in the UK, where you can advertise stuff in order to sell and rent out, that kind of thing. That one's up 8%, as I say, the best one we've got in Europe. CTS Eventim, the events company, they've got the rights for the Hammersmith Apollo, one of the best venues in London. That one jumping. They've got an upgrade, a broker move today, pushing that one higher. So there is some positivity on that one. And in London, Card Factory doing really well. It's a really short statement. It was literally about 2 sentences. All they said is that trading is better than expected. But given that one's fallen so much since when it IPO'd a few years ago, and the downbeat view on the UK consumer, that one rocketing, didn't take much to send that one high, and that one's up 16% in London. Siemens Energy is a surprising one. We had it on the losers, had to flip it over to the gainers because it reversed a 7% drop at the open. It's now up 3%. We'll have to read into exactly why, what the positivities are there. But we did speak to the CEO of Siemens Energy earlier in the show, so take a listen to what he had to say.
We have had to take charges of 1.6 billion for quality-related cost in the onshore business of wind related to 2 platforms. These were issues which occurred after a certain runtime of the turbines. And we had additional 600 million charges at Siemens Gamesa to take because of the ramp-up of the offshore business. There is a high demand, that's good, but we are ramping up around 4 factories at the moment in parallel, and these are affected by obviously shortage in construction workers, completing the factories, ramping up materials, and so forth. The other thing is obviously it really overshadows an outstanding performance of the conventional energy business. It was around at 1.4 billion profit to date, and obviously really with a fantastic order book, and that is really, really painful. But the other thing is we have already, since the talk on 22nd of June, established mitigation measures, including establishing a task force at Siemens Gamesa and fixing the quality problems and addressing it now step to step. But definitely, I mean, this is a situation where we are reviewing the different elements in terms of how can we, as fast as possible, really stabilize the wind business, because it is strategically an interesting growth business, but obviously we have to be able to operate in this field profitably.
So what do you know about the causes of the flaws in the newer onshore turbines, and what are you doing to fix those issues?
Yeah, and as I said, I mean, these are related to a certain operational time, and this is a relatively diverse picture across the different turbines. First of all, I think it's important to understand that these are issues which currently do not affect the operation of the turbines. So the turbines are producing power for our customers. However, we have relatively early on identified issues around the blades and the bearings, so 2 main components in the turbine which need a rectification for some of the turbines in the fleet. It is always a mixture between specific suppliers which have provided these parts and obviously also conditions at site.
That was Christian Bruch there, the CEO of Siemens Energy. And thanks also to Joe Easton from our equities team for that roundup. Some pretty big volatility in those Siemens Energy shares. Open down, now moving higher. And perhaps that's a good way to start the conversation when it comes to earnings season. There's been a lot to dig through, a lot of confusion, even a lot of messy reports. Let's get the overall view with Bloomberg Intelligence's Tim Craighead, who's always got a breakdown for us. Tim, what is your take so far on what we've gone? We're most of the way through the second quarter earnings season. Has it been good? Has it been bad? I mean, it's kind of hard to tell when you see, again, something like Siemens reacts poorly to the earnings, then turns around quite suddenly.
Yeah, no doubt. Well, take a step back. We're more than 80% done, so that's good. Our overall assessment is pretty constructive. If you take a look at the beats and misses, we're running north of 50% beat, about 30% miss, so that ratio is solid. You could take some pause by looking at a 10% decline in overall EPS for the stock 600 as it's tracking. But that's better than the 12% decline that was expected, number one. And number two, if you back out energy and materials, which are substantial sectors, and they've got harsh earnings because of year-on-year comparisons with the underlying commodities. If you back that out, 7% earnings growth. So very respectable profitability, especially given the economic backdrop that we're in.
What about some of these consumer stocks? Because I was just thinking about this week. Mark and I had talked to Heineken last week, and they had some pretty poor consumer earnings. And I think about AB InBev, which had really strong earnings. How much of sort of the Heineken-type consumer companies are the one-off or are, again, the norm? How are you thinking, and how have we seen those numbers shape up?
So broadly speaking, if you look across whether it's discretionary with, say, luxury goods, autos, or you look across staples, we've had better than expected earnings at the sector level. If you dig into the details, I think on the staples side, some of what we see is ongoing portfolio restructuring, which is important. You know, this is a group that's taken a lot of price. They've raised price to protect margins when input costs were inflating over the course of the past couple of years. And now they're in the midst of you know, Nestle's a good example, jettisoning some businesses that they don't want to be in, reevaluating their mix, getting rid of some lower end products and whatnot. And that's, I think, going to be an ongoing part of the story for those big consumer staple companies. They can't push price forever, especially in an economic environment like this. And that reorganization sort of activity is important.
Yeah, and a lot of reorganization at the C-suite, like just Adidas and Unilever, just who I can think of off the top of my head, who've also had a reorganization on that front. Tim, so 80% of the way there, earnings season is almost over. We're about to get into those weird summer months. I mean, we're already in the weird summer months. Usually August, not great. The seasonality not in favor of European equities. What are your expectations?
Yeah, you know, it's an interesting thing because thinking about technical factors, thinking about seasonality, you know, generally speaking, I try not to pay too much attention, but at times, you know that it can be almost a self-fulfilling prophecy. And if you look at some of the seasonality functionality on Bloomberg, it's pretty good stuff in terms of seasonal charts. You can see year in and year out, August and September are two of the poor months for European equities. And it's true for the region, it's true for several of the individual countries. And you take that, we're in an earnings vacuum. We've had, you know, a decent reaction to earnings overall. Market's still at a reasonably high level. You know, you've got the DAX that's close to pushing a record, et cetera, et cetera. And you lay in with the UK and the Swiss markets in particular, a converging wedge where we've seen lower highs over the course of the past 3, 4, 5 months. We've seen higher lows on a longer-term trend line, and we've got that wedge coming in, and that tends to make you think we've either got a break up or a break down. FTSE is about to, or actually it's just initiated a death cross. So there's all sorts of interesting technical factors that are worth watching. And in this lull, maybe a sloppy market the next month and a half.
Tim, for a man who says he doesn't pay attention to technicals, that was such an excellent roundup of all the technical signals. Tim, always a pleasure to have you on. Tim Craighead. And for more analysis and insight from Tim and the team, Bloomberg Intelligence for this earnings season, BI Go is where you want to head on your terminal. Now, coming up, Israeli Prime Minister Benjamin Netanyahu tells Bloomberg that he's pulling back on some of his judicial revamp plans. We're going to have that exclusive interview for you next with Francine Lacqua. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Markets Today, just over 45 minutes into your European trading. A real sustained turnaround we're seeing in markets. Future session was pointing down, the open was pointing lower, but now we're having a lot of these regional indices begin to rally, maybe picking up on the American equity rally in the futures market. Okay, let's talk about Israel, because the Prime Minister, Benjamin Netanyahu, says he will seek to change how judges are named, but won't pursue the entire judicial overhaul originally planned by his government. Let's bring in Francine Lacqua, who spoke to him exclusively. Francine, it is quite a contentious time for Israel right now, and some of these judicial overhauls that Netanyahu is planning. What were some of your takeaways from what he told you?
Well, it was very interesting. First of all, he was very generous with his time. We had about 15 to 18 minutes, which is quite rare. He invited us to go and see him in the Prime Ministerial office. And through the conversation, he tried to appease the markets, right? He kept on saying, look, I know at the moment it's hard. I know this country's divided, but you almost have to trust me. We'll get through this, which the markets are not 100% trusting him because you don't exactly know what's next. So he did say that he will do more in terms of judicial overhaul, but he's already done that much. I mean, he got rid of this reasonableness clause, which basically gives a lot less power to the minorities if you have a hard-wing government in charge. But we also spoke about central bank independence, and this is what he had to say.
I'm absolutely sure that Israel will come out stable and successful and democratic, at least as democratic, in my view, more democratic. I don't think we're going to tear the country apart. I don't think you're going to have civil war. I think right now what you're seeing is the natural conflict between two opposing views that have not yet meshed, but they will mesh.
Do you support your central bank governor, who is very well respected internationally?
Sure. I appointed him.
Will you back him for another term? He has to decide, I think, by next month.
Well, I haven't talked to him yet, but I will. But I've guarded, I would say, rigorously his independence, the independence of the central bank, and that will continue to be the policy. I will talk to him, but you wouldn't believe this, but we just not had the opportunity to discuss that.
But, Prime Minister, when you talk to him, will you ask him to stay on?
Possibly. I want to think about it. I haven't
what are you
had
thinking
time.
now?
I think he's been an exceptional central bank director, and I think that's a possibility that I'll have to talk to him about.
One of your ministers, I think, called him a savage for raising interest rates.
Yeah, well, my ministers in our hectic parliamentary system can say anything, but it's a fact that we've never intervened with the independence of the central bank, and we won't.
And so
in fact, I think I passed some laws or corrective additional laws that safeguarded the independence of the central bank. I do not want the government broaching in on what the central bank has to do.
So do you support the interest rate hikes?
I leave that decision to the central bank. You know, I've had several central bank directors because I've been in government a long time. I think in a few months I'll be probably more time in as prime minister than anybody in the Western world for the last half century. So I've had a lot of central bank directors to talk to. I always talk to them in a padded room, absolutely soundproof, that we could, you know, hurl at each other whatever we want. But when I come out, I always give backing to the central bank director.
But, Prime Minister, it would be a pretty powerful message to the markets, given the divisions and given the turmoil, if you were to ask him to stay on.
Could be. That's a consideration. I'll consider it.
But do you agree? Would that be a powerful message?
I think the powerful message is the independence of the central bank. And I think the choices that I've made in bringing in central bank directors, whether it was Stanley Fischer and after him, the current central bank director, I think people see that we choose and choose well.
So look, over 18 minutes, Dan, we spoke a lot also about AI in the end, growth prospect for Israel. But the general idea is that, look, the dust he thinks will settle. He would not, once again, he did speak to quite a lot of international media over the last 2 months because of this turmoil. He would not settle, or he wouldn't say that whatever the Supreme Court decides on whether even the legality of him removing this reasonableness clause, he'll abide by. So many question marks.
I also want to know what it was like to get into that room. I've been through security at Ben Gurion. I can imagine that it's a lot more to get into the Prime Minister's office.
We showed up about 5 hours before just to make sure that everyone could get there in time. And let's put it this way, they're very, very thorough in checking everything and how everything's made to make sure that the Prime Minister is safe.
I was going to say, I'm sure he and you both felt safe after 5 hours through security. Francine, thanks so much. Francine Locke there with an exclusive interview with the Israeli Prime Minister. All right, coming up, we're going to dive back into markets and look how traders are positioning themselves to U.S. recession expectations. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
This is Market Today, almost an hour into the European trading day. I think this is really evocative of a summer month. I mean, we're struggling for direction. At one point when the market first opened, we were falling much lower, now basically unchanged. We were higher before. Nothing to really move us, not too many earnings. But perhaps we're going to get some more movement in the months to come. Let's talk about what's happening with Bloomberg's cross-asset markets reporter, Justina Lee. Justina, you flagged this to the team, the MLive Poll Survey. And this one is interesting because it's at a time when a lot of strategists are kind of erasing their U.S. recession bets, either pushing them out or saying it's not going to happen. But the respondents in the MLive survey, a whole load of contrarians.
Yeah, it's pretty interesting because this survey kind of polled 400 respondents, and 2/3 of them actually think that there's going to be a recession by the end of next year. And 20% even think that one is going to happen this year, even though we're like rapidly entering the second half. And so it's kind of interesting because obviously a lot of these investors have probably been wrong with the same bet earlier this year. Like if you thought the recession was coming, you would have missed out on that monstrous US stock rally. But it's kind of funny that people at the end of the day still think that stocks cannot escape the economic gravity of monetary tightening.
Talk more about that. So is it just like an earnings recession that's expected?
Yeah, I think that's part of it. I mean, this past earnings season was actually kind of decent compared to what people were already expecting. But I think at the end of the day, I mean, we've had a year of really rapid rate hikes. And historically, it's always hard to kind of avoid a recession in that scenario. And even though we haven't seen that many signs of an economic slowdown, I think the bet here is that ultimately, you know, there is a bit of a lag effect from monetary tightening. So we are going to start seeing that. I mean, kind of despite what we saw in the jobs report last week, which was kind of still showed like a pretty strong market.
And this is why it feels like people are unable to let go of that recession call because it just defies historic norms. But again, we've seen a lot more folks come out of the woodwork saying that it's actually because of this fiscal policy tailwind. It's because of the Inflation Reduction Act that we're going to get that. Now, a lot of that confusion has also been playing out in the bond market. What did MLive survey respondents say to that? Because we have seen this sell-off in duration. Do people want to buy duration right now?
Yeah, I mean, if you think a recession is coming, you do want to buy duration.
Totally.
And that's what this survey is telling us. I mean, they're kind of recommending kind of long-end treasury bonds. And I think that is interesting because kind of given how much that has declined. And of course, for stocks, it's the opposite conclusion. And I can see how for stocks, maybe the bar is even higher to exceed expectations now after the rally that we've had this year.
I am just thinking it would be so 2020s for everyone to say there's not going to be a recession anymore and then just to get a really bad recession this year. That feels like what we deserve, honestly. Justina, thank you so much. As always, that's Justina Lee from the Bloomberg Cross Asset team. And we did just get a note from Mike Wilson over at Morgan Stanley just a few hours ago. And it is this idea of can the market impulse continue? If we're now starting to worry about that Fitch downgrade, more of the auctions coming into market, perhaps that growth trajectory will change. Perhaps we'll start to be worried about growth. We are getting about $103 billion worth of treasuries coming to markets this week. Will we absorb that? Are yields high enough that it can tempt traders into that market? Or again, are we going to see this disdain like Bill Ackman for duration? All right, that's it for markets today. You can get more insight from us and the team on the front pages of the Bloomberg UK website or by going to TLive Go on the terminal.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Traders assess a mixed U.S. jobs report for clues on the Fed's next decision as officials debate further rate hikes ahead of this week's CPI report. Europe starts the week in the red. Israeli Prime Minister Benjamin Netanyahu tells me exclusively he will not pursue the entire judicial overhaul originally planned by his government.
I don't think we should move from one extreme where we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes.
Plus, a week climbs. Ukraine's drone attack on shipping put Russia's commodity exports at risk. So let's take a look at the European markets map. A lot going on. First of all, happy Monday, everyone. It's going to be a big week also as we watch those U.S. bond auction dates. Now, if you look at the short-term German bonds, they're actually rising. The central bank saying would stop paying interest on domestic government deposits, and that's definitely spurring a dash for higher yielding cash. Now, if you look at Germany's two-year, extremely sensitive. The other big story is, of course, what's happening with treasuries. So let's get on to treasuries. But before that, the NASDAQ, because of the report that we had on Friday. Now, we're seeing in futures NASDAQ higher a touch after the sell-off that we saw on Friday. Then Treasury yields also advancing, reversing some of Friday's declines when the interest rate sensitive two-year yield and the 10-year yield actually fell more than 10 basis points after the U.S. payrolls came in below estimates. And then this is the interview that we did over the weekend. We spoke to the Israeli Prime Minister Benjamin Netanyahu. He tried to really tell the markets that, look, the dust will settle, that things will get better, and he won't continue with as much aggressive with his overhaul of the judicial system. For the moment, you can see the shekel 36634. Now, joining us to dive into the markets is ADA Economics founder and chief economist Raffaella Tenconi, and with me here in the studio in London are Bloomberg Markets Today managing editor Christina Kina. So thank you both for joining us. Raffaella, let me start off with you. I don't know what you make of the U.S. jobs data on Friday and how that will influence not only auctions for treasuries this week, but actually what the Fed does.
Hi, good morning. Well, labor market in the U.S. is softening very slowly, but de facto it's not an alarming slowdown. It's softer than last year, occasionally, a little bit stronger, a little bit softer in the last few months. But essentially, we think we are in a period where you're very unlikely to see much of an abrupt halt in the labor market. Essentially, We don't think central banks will get the rise in unemployment rate and sustained moderation in wage growth in the coming year that they hope to see. The thing that you can hope is that gradually job creation is slightly less active. Maybe you get an increase in the unemployment level, but not so much the unemployment rate. And this is essentially going to shape GDP outlook for the next year.
What's your take, Christina, on the longer-term impact of this? Again, we're still trying to figure out exactly where the dust settles. You could also see, and we have CPI print this week, we could see it lower and then higher by the end of the year.
Yeah, Francine, I mean, it was really mixed signals from that jobs report last week. And I think it will bolster the argument that some of the more hawkish members of the FOMC to add more rate hikes to the Fed's path in the next coming months, even though we did see them pause in June and then do some more in July. But yeah, I think that is the idea, is that what this will signal to some of the hawks is that essentially the U.S. labor market is doing just fine, and so it can withstand probably more tightening down the line. And meanwhile, that wage growth number still showing signs of inflation, despite that cooling in the headline number. We are seeing wage inflation specifically remaining sticky in the U.S., and that's something for the Fed to address for sure.
Christine, should we worry about the bond auctions for treasuries?
I mean, it's certainly something to keep an eye on, especially more closely now that we've gotten that Fitch action. But yeah, I mean, I would expect these auctions to get a little bit more attention, just because, you know, this idea of the U.S. kind of struggling with this fiscal future. It's not an immediate issue, obviously, and again, it hasn't really done much to dent consumer confidence in treasuries as a viable investment option. It is still the world's biggest, most deepest, most liquid bond market. So it has that going for it. But yeah, certainly, I think questions more and more over the U.S.'s fiscal responsibility, really, over the coming decades or so. Definitely something for investors to watch.
So, Rafaela, what's your take on where we are in the cycle? I know it's a very different business cycle, and I know you've also pointed this in your research to what we've seen over the last 3 decades.
Yes, essentially, we think that you should think of the business cycle as a completely different mechanism than the last 3 cycles. The last 3 cycles, we had a ramp up of debt, aggressive monetary tightening, labor market was loose when the tightening was taking place, or much looser than what it is now, because we had the aging of the population not as advanced as now. And we had fiscal policy that was only coming to play maybe a year or a year and a half after the recession happened. Now what you have is that fiscal policy de facto has been loose since 2020. Aging population is really affecting the labor market. And we had a ramp up of assets more than debt when you look at developed markets. So the best way to think about the business cycle, it's a bit like an emerging market. The downturns are going to be more frequent, but shallower. So this is why you never get quite to the recession that you need to really get into the disinflationary phase. Inflation is still behaving within a cycle. You know, right now it is de facto decelerating, although maybe the August and September print are going to be less decelerating than what we had expected a few months ago. But de facto, you really need to change your mental map. Don't look for the recession. Okay, right. Look for the twists in the data.
All right, we'll look for the twist, and I'll ask you more about those twists shortly as well. Rafaela Tanconi and Christina Kino both stay with us. Now, Israel Prime Minister Benjamin Netanyahu says he will not pursue the entire judicial overhaul originally planned by his government. He will instead work on changing the makeup of the judge selection committee.
I'm still going to give it several months to try to get another consensus. What is it? It would probably be about the composition of the committee that elects judges. I don't think we should move from one extreme where we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes. There has to be a balance. That's what we're trying to restore.
That was the Prime Minister of Israel, Benjamin Netanyahu, speaking to us exclusively over the weekend in Jerusalem. Now, we'll be bringing you more of my exclusive interview with the Prime Minister later this hour. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
I've expected the economy to slow down in a fairly orderly way, and this number, the 187, comes in continuing that pace. But I'm comfortable. I'm not expecting this to be over in a short period of time.
The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far. When we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation. You know, the price series, and especially the new months of inflation in the court.
Atlanta Fed President Raphael Bostic and Chicago Fed President Austin Goolsbee. They're speaking with Bloomberg's David Weston in Aspen. However, the Fed's governor, Michelle Bowman, said the U.S. Central Bank may need to raise rates further in order to fully restore price stability. Well, still with us, ADA Economics founder and chief economist Raffaella Tenconi and Bloomberg's Christina Kina. So thank you both for staying with us. Raffaella, I don't know how hard it is, first of all, to measure productivity, given all of the swings that we've seen with COVID, but also is the hardest part getting inflation back to target now, so that 4% to 2% move that could be quite disrupted. I know you say, look, don't look for a recession, but how hard is it going to be for central banks not to mess up here?
Well, it's quite hard, because if you don't have the rise in unemployment that normally the downturn in the business cycle delivers, then it's very hard to see the increase in productivity that comes usually in this phase. So what you really need is the genuine long-term productivity, which we actually need, and will come as we learn to use energy, green, and digital transitions better. So it's a journey that is going to be at least 3, maybe 5 years long. So the best way to see it is to make sure that there's continuing investment in the next years in these segments, and that the corporate sector doesn't polarize too much. Essentially, what you see now in earnings is that a lot of earnings tend to be concentrated. Ideally, you want earnings to be as evenly spread within the economy as possible, so that everybody has the time to learn how to use the new technology effectively.
Yeah.
In the near term, unfortunately, you have to deal with the fact that energy is going to be inflationary in August and September. And as I said, the wage pattern isn't going to make the Fed relaxed.
And Christine, we also, speaking about, the bets on a recession, we also have our own MLive pulse survey we're a more optimistic bunch.
Yeah, I mean, at least for 2023.
When I say we, let me just make it clear it's our guests. So
yes, exactly.
People who use the Bloomberg.
Exactly. So a bunch of investors that we've surveyed looking more optimistic, at least for 2023, and not really seeing a recession until next year. But they are still holding on to those bets, which is quite interesting, right? Because we have seen that soft landing narrative take more hold in July, because we did get signs of cooler inflation in the U.S. And then, of course, the labor market, as we know, is still holding up really quite well, despite the softer payrolls number on Friday. But yeah, I think, you know, there's still that idea that eventually we are going to get this recession. It's just a matter of when rather than if. And in that scenario, they're definitely going with the traditional buying bonds and selling stocks sort of play. Although we have seen, of course, the bond market upheaval recently, driven by the Fitch rating downgrade for the U.S., as well as more Treasury issuance, kind of pouring a little bit of cold water in that Treasury bullish trade, right?
Yeah. I know the timing maybe wasn't
you
know, it was pretty, let's say, efficacious if you want to put concerns in traders' minds. We also have the story that really caught my eye. KKR and the Fuchs family are seeking to take tech firm OHB private. I mean, is there going to be more of a trend of actually some of these companies that are listed that private equity want to take private because there's just a lack of deals out there?
Yeah, I mean, generally, I think that does seem to be one viable option, especially for struggling companies that are really having a hard time tapping capital markets and for traditional sources of funding. But I think also there's an element of specificity here in this deal, because it is very much within that satellite space. And we of course, know there's been a lot of interest in kind of commercial space flight. Of course, Elon Musk, Jeff Bezos, just among some of the prominent names, are kind of really trying to grow the commercial space flight space. And so I think, you know, the consolidation in the industry, as you mentioned, because of the difficulties of sourcing funding at the moment, makes a lot of sense for these companies, especially if they want to compete with those big names.
Yeah, Rafaela, very quickly, what's your take on productivity? Is it going to be worse or better as we go into this next phase of the cycle?
I hope it's going to be better, but I think we need to still do a lot of institutional improvement to really learn how to get the productivity out of, especially digital technology, which is the core of everything we're trying to do. So it's more of a hope than a reality at this stage, I think.
All right, Rafaela, as always, thank you so much. Ada Economics founder and chief economist Rafaela Tenconi, and Bloomberg's Christina Quino also joining us this morning in the studio. Now, coming up, 80% of European companies have reported for the second quarter so far. So we'll break down the winners and the losers next. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Welcome back, everyone. So Saudi Aramco has raised its payout to shareholders by more than half. That's as the world's biggest oil exporter announced a performance-linked dividend despite a drop in quarterly profit. Now for more, let's bring in Bloomberg's Middle East energy markets reporter, Anthony Di Paola in Dubai. Good morning, Anthony. So what do you make of these numbers?
Good morning, Francine. Yeah, this is Aramco going along with kind of the trend that we've seen in the industry so far in this period of quarterly earnings. We've seen profit come down for all the oil majors, and then a lot of return of cash to shareholders via payouts, via buybacks. So Aramco's going again in that vein, in part because they need to funnel some money into the Saudi government to fund those ambitious growth plans of Crown Prince Mohammed bin Salman as he's trying to transform that economy into more of a manufacturing base, tourism, technology. On top of that as well, Aramco's got to compete with the other companies to try to attract those investors in with those greater payouts. So really, that's a slight increase in the regular dividend plus that additional performance-linked dividend, which Aramco says they're going to pay out for the next 6 quarters as well, starting in the third quarter with this first payout. So it is quite big. Their free cash flow for the second quarter doesn't quite make it to cover the regular dividend plus the special dividend, but they are putting that dividend based on the profit from 2022, from the first half of 2023, so that kind of that first half free cash flow does cover that dividend, Francine.
So, Anthony, what's Aramco's outlook going forward, and where's the company actually headed in terms of production?
Yeah, we're hearing now from the CEO, Amin Nasser. He's saying that they see demand increasing to about 103, 104 million barrels a day by the end of this year. Many forecasters are saying that oil demand is going to hit an all-time record before we're finished with this year. So he sees demand increasing. He is optimistic on China. That's their biggest customer for their oil. A lot of the people that we've been talking to have been saying, you know, that Chinese recovery that we've been waiting for hasn't happened yet. It's slow to come. The economy's still sluggish, but he's taking an optimistic beat, saying that they've got that demand coming. Remember that Saudi Aramco is cutting production because of those OPEC plus cuts and a voluntary cut that Saudi Arabia signed up for. He's saying they've still got the oil to meet their customer demand, Francine.
Anthony, as always, thank you so much for all of your insight to Bloomberg's Middle East energy markets reporter, Anthony Di Paola. Now, shares in German space technology company OHB are surging after KKR announced plans to take it private alongside the founding family. That's as competition in the satellite sector actually heats up. Now, investors will receive 44 euros for every OHB share, and the offer values the company at around 1 billion euros, including debt. The news does confirm an earlier Bloomberg report that the U.S. buyout firm was close to announcing the deal. Now, the European earnings season is winding down, with more than 80% of firms having reported so far. This week, we're looking at nearly $1.6 trillion in market cap reporting here in Europe. So joining us with the breakdown is our Bloomberg Intelligence Senior European Equity Strategist and Research Director, Tim Craighead. Tim, maybe people can go on holiday here in Europe, but I think in Asia, there's like 1.8 trillion in terms of market cap that's reporting. So we're not quite done with all of these earnings. Overall, was it better than expected?
quick answer is yes. And in Europe, we're well north of 80% now in terms of the market cap that's reported. So this is the last big week. And if we look at an overall assessment, we've got more than half that are beating. We've got about a third that are missing. The ratio, therefore, is pretty typical and pretty robust. You might take pause and say, how can you say it's a good earnings period if earnings growth is actually a 10% decline? But the expectation was for 12, so it's a little bit better there. And importantly, if you take out energy and materials, given the year-on-year comparisons of commodity prices and profits, as you were talking about with Saudi Aramco, earnings growth is actually a very respectable 7% for the overall European market. So pretty solid.
And so what surprised you the most in all of this? I mean, is there something that's eye-catching? I don't know if there are sectors that could have done better and done worse, or vice versa.
So I suppose two things really jump out to me. One is profit margins. Again, Xing out energy and material. Every other sector was up year on year, positively surprised across most. And this isn't mediocre sort of profitability. We're at record levels ex energy and material for the stock 600, notwithstanding the economy. So, companies have been aggressively taking price. They've been doing various cost mitigation exercises. That continues to come through. Second thing, in terms of surprise, is it's not so much the earnings surprise that had a big impact this quarter. It was management guidance. Okay. Generally speaking, positive guidance, okay. But if you had negative guidance, stocks were off significantly. So that's where the asymmetry was on the surprise front.
Okay, really interesting. Tim, thank you so much. Tim Craighead there with the very latest on some of the earnings here in Europe that we've seen so far. Now, for more analysis and insight from our team at Bloomberg Intelligence this earnings season, just check out BI Go on your Bloomberg terminal. And Elon Musk says his proposed cage fight with Mark Zuckerberg will be live streamed on his X platform, previously known as Twitter. Now, the world's richest person says all proceeds will go to a charity for veterans. He later posted that the exact date of the fight is still in flux. Musk says he's getting an MRI scan for his neck and upper back. He says he may require surgery before the fight can happen, and we'll know this week. Musk, a notorious workaholic, says he's been suffering from mega back pain after a bout with a sumo wrestler, and Zuckerberg's a martial arts enthusiast and competed in a jiu-jitsu tournament earlier this year. There is also an open invitation to have the cage fight here on The Pulse. Coming up, Israeli Prime Minister Benjamin Netanyahu tells us he's pulling back on his judicial revamp plans.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Traders assess a mixed U.S. jobs report for clues on the Fed's next decision as officials debate further rate hikes ahead of this week's CPI report, while Europe starts the week in the red. The Israeli Prime Minister Benjamin Netanyahu tells me exclusively he will not pursue the entire judicial overhaul originally planned by his government.
I don't think we should move from one extreme where we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes.
Plus, wheat climbs as Ukraine's drone attacks on shipping put Russia's commodity exports at risk. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So Israel's Prime Minister Benjamin Netanyahu says he will work to change the makeup of the Judge Selection Committee. He will not pursue the entire judicial overhaul originally planned by his government. This comes after months of protests as critics argued the overhaul would undermine the country's democracy. Well, Netanyahu says Israel will come out of the current turmoil stronger. He also told me that he's confident in the Bank of Israel Governor Amir Yaron and the central bank's independence.
I'm absolutely sure that Israel will come out stable and successful and democratic, at least as democratic, in my view, more democratic. I don't think we're going to tear the country apart. I don't think you're going to have civil war. I think right now what you're seeing is the natural conflict between two opposing views that have not yet meshed, but they will mesh.
Do you support your central bank governor, who is very well respected internationally?
Sure. I appointed him.
Will you back him for another term? He has to decide, I think, by next month.
Well, I haven't talked to him yet, but I will. But I've guarded, I would say, rigorously his independence, the independence of the central bank, and that will continue to be the policy. I will talk to him, but you wouldn't believe this, but we just not had the opportunity to discuss that.
But, Prime Minister, when you talk to him, will you ask him to stay on?
Possibly. I want to think about it. I haven't
what are you
had
thinking
time.
now?
I think he's been an exceptional central bank director, and I think that's a possibility that I'll have to talk to him about.
One of your ministers, I think, called him a savage for raising interest rates.
Yeah, well, my ministers in our hectic parliamentary system can say anything, but it's a fact that we've never intervened with the independence of the central bank, and we won't.
And so
in fact, I think I passed some laws or corrective additional laws that safeguarded the independence of the central bank. I do not want the government broaching in on what the central bank has to do.
So do you support the interest rate hikes?
I leave that decision to the central bank. You know, I've had several central bank directors because I've been in government a long time. I think in a few months I'll be probably more time in as prime minister than anybody in the Western world for the last half century. So I've had a lot of central bank directors to talk to. I always talk to them in a padded room, absolutely soundproof, that we could, hurl at each other whatever we want. But when I come out, I always give backing to the central bank director.
But, Prime Minister, it would be a pretty powerful message to the markets, given the divisions and given the turmoil, if you were to ask him to stay on.
Could be. That's a consideration. I'll consider it.
But do you agree? Would that be a powerful message?
I think the powerful message is the independence of the central bank. And I think the choices that I've made in bringing in central bank directors, whether it was Stanley Fischer and after him, the current central bank director, I think people see that we choose and choose well.
Israeli Prime Minister there, Benjamin Netanyahu, speaking to us exclusively over the weekend in Jerusalem. Now let's bring in Bloomberg's Israel Bureau Chief. He's Ethan Broner. Ethan, thank you for joining us. Overall, how was the interview actually received in Israel? I know the country is divided. There are many questions on what this means also for the judicial overhaul going forward.
Indeed. Good to see you, Fran. Look, it was the big news here with banner headlines in Haaretz and Yediot and the other major newspapers. But as everything having to do with this government and with Netanyahu, it's highly divisive. So on the one hand, he said to us, I'm going to move forward with judge selection. On the other hand, I'm not going to do these other steps that I had planned. So many people said, you see, he's moving ahead with judge selection. He's going to politicize judge selection. The rest doesn't matter. He's a future dictator. And there's a lot of anger about it. On the other hand, he's saying, no, we're going to negotiate. We simply want to move the needle a bit. We'll have to see how it comes out. As he said to you, let's talk in a year.
In the meantime, I mean, when we look at the big number for the economy, it's $520 billion, right? This is the Israeli economy that's under pressure from this political upheaval. Do we have any insight into what happens next, what investors are looking for?
I think, at the moment, the markets are relatively steady. The shekel is relatively, nothing huge happened as a result of this interview or what's happening. I think that we're going to have to see where this judge selection issue goes, as well as a whole bunch of other things. There's the reasonableness basis for judging that has been removed from judges by the Knesset and is now going to be heard by a full 15 justices on the 12th of September. There's also another law that this Knesset has passed, making it very difficult to remove this current prime minister on the basis of incapacitation. That's also being looked at by the Supreme Court. We don't know. I think that the business community has been very nervous about what is happening here. On the other hand, there's such a strong basis, as you say, in this $500+ billion economy that it is being still quite attractive for investors.
So, Ethan, what happens next? At the moment, they're in summoned recess, and then, come the start of fall, we'll hear from the Supreme Court on whether what they decided is even legal.
Right. So there are two Supreme Court issues. One is this incapacitation. That's underway right now. Another is this reasonableness thing. That's on the 12th of September. Meanwhile, the Prime Minister has asked the opposition to gather and discuss at a table how to move forward on judge selection or on anything related to judicial overhaul in the coming months. The Knesset is on recess till the middle of October. And the idea is, he said, I'll give you to the end of November to let's work this thing out. The opposition is very angry at him. It says it's not particularly interested in negotiating unless he promises to do nothing on judiciary going forward. We'll have to see where it comes out. The president, Isaac Herzog, has been trying to bring the two sides together and find middle ground. He got somewhere, but then it fell apart. Will he be able to do it again? We don't know.
Yeah, and he also said that, he's going to try and deepen some of these economic and business, ties with Saudi Arabia. But many question marks on whether he'll be able to do that, Ethan.
That's an enormous question. I mean, one of the things about trying to observe Benjamin Netanyahu over the decades is that he has defied conventional wisdom often to his success. He did it on gas exploration here. He did it on expanding relations with the UAE, Bahrain, and Morocco without making serious concessions to the Palestinians. And he says he can do the same again with Saudi Arabia. A lot of people think the magician may be out of tricks and that he can't. And I think this is the incredible high wire act that we see him engaged in. And it's very, very hard to know who's going to win. He is also under pressure because he's under prosecution. He's under charges of bribery and fraud and so on. So there's a lot of pressures on him. And he's 73. He had a heart pacemaker put in. It's hard to know whether he can pull it out, his magician hat, one more time. It's really hard to know.
Ethan, thank you so much. Our Bloomberg Israel bureau chief, who's of course with us at the interview with all of the preparation that he put into that. Ethan Broner joining us, of course, from Tel Aviv. Now, more from our interview coming up after the break, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, going back to our exclusive interview with Israel's Prime Minister, Benjamin Netanyahu, he says he won't pursue the entire judicial overhaul originally planned by his government, and he says he's seeking a balance.
Well, I think that we've already done quite a bit. I've stopped the judicial legislation for 3 months, seeking consensus from the other side, unfortunately not getting it, then brought in a relatively minor part of the reform, passed it, and then said, I'm still going to give it several months to try to get another consensus. What is it? It would probably be about the composition of the committee that elects judges.
With the selection of the judges?
Yes.
How they're selected?
Right. That's basically what's left. And because other things, I think, we should not legislate. I don't think we should move from one extreme where we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes. There has to be a balance. That's what we're trying to restore.
So Prime Minister, when you look at the change in selection for the judges, how quickly could that come?
Well, if we get a compromise, it could come immediately. If we can't get a buy-in from the opposition in the parliament, there's always a buy-in from the public. What is the thing that the public accepts? And I'm giving it my best shot. I'm spending, I wouldn't say 24 hours a day on it. I'd say about 12 hours a day.
And if the public is not behind it, what do you do? Do you
I think
delay?
you should
Do
choose
stop?
something. I think you should choose something that has broad acceptance.
Which looks like what?
Which looks like something that I'd like to negotiate, not even on Bloomberg.
Okay, but give me a flavor of is it walking back some of the things that have been said by certain ministers
I think,
around you?
Oh, ministers can say anything. I don't control words in our parliamentary system. I control deeds, and that has to be understood. But since you know the European system, you know that unlike a presidential system, you don't control what is said by members of your cabinet.
But you can ask them to tone it down. Have you asked them to tone it down?
100 times.
And they're listening?
I succeeded 50 times.
And you'll
You
continue to
don't
do
always
so?
succeed. You don't always succeed. But that's what's important to understand is when the dust settles, are we going to have Israel that is stronger democratically, or is it weaker democratically? Is it something where you're going to have the balance that you need between the will of the majority and the rights of the minority or individual rights? Has that been strengthened, that balance, or has it been weakened?
Well, still with us, our Bloomberg Israel Bureau Chief Ethan Broner. Sir Ethan, are we expecting many more protests as the judicial overhaul continues, even if the Prime Minister says, you know, it maybe won't be as aggressive as some people initially thought?
Yes, the expectation is there'll be continuous Saturday night protests. So I think that the protest movement, which has been going strong for 7 months, has made the decision that it's a bad idea to stop. They need to keep the pressure up. They can't do the kind of days of disruption. They don't have quite, it's the middle of August after all, and the Knesset, the parliament, is on holiday. So, but they are planning to continue the Saturday night protests, which gather in the main cities. And they've also put out a statement yesterday, an angry rejection of what the Prime Minister said to you, to Bloomberg yesterday about judge selection. They find that to be far away, a bridge too far, and that they believe it's going to lead to a kind of power grab, ultimately a form of dictatorship by the ruling party.
But Ethan, if you take away, right, the idea of the reasonableness criteria from the Supreme Court, then is there anything else really that you can take away and make it, you know, less democratic? It feels like you're not protecting the minority if you take that criteria away.
Well, I mean, the thing is, it's rather difficult to know. The use of reasonableness has been relatively limited, to be fair. There are other aspects, other ways in which the Supreme Court can protect minorities. There's other tools other than reasonableness. People are worried that any tool you take away from this court is bad news. You know, there is certainly reason to believe that the court will continue to be able to function, although, as I say, the protest movement and the opposition is adamant that these things are really crossing a line and removing vital checks and balances in the Israeli democratic system.
Ethan, thank you so much. Our Bloomberg Israel Bureau Chief Ethan Broner there with many, many insights after many decades of experience. Now, Ukraine has taken Russia's war into the Black Sea using drone strikes to cripple a Russian naval vessel and oil tanker. Wheat extending gains this morning. Joining us now is our Bloomberg senior reporter for international affairs. He's Mark Champion. So, Mark, thank you so much for joining us. So what exactly are the implications with the Black Sea escalation, both for Russia but also everyone else?
Yeah, I mean, it is significant. I mean, Russia kind of began this when President Putin pulled out of the grain deal that had allowed Ukrainian grain exports, stabilizing world markets, also very important to the Ukrainian economy. So when he did that and then began destroying port infrastructure, he really began to expand the war into a new dimension. And this is the Ukrainians, literally the defense ministry, saying two can play at that. And so they have now begun to take the war to the extent they can using naval drones to Russian shipping in the Black Sea. And you already see, you know, wheat futures up, even though no, wheat carrying cargo ships were hit. You've got a lot of oil going through as well. So it is an important moment, actually, in the war.
And what came out of the meeting with Saudi Arabia?
Also very interesting. I mean, here you have a meeting, you know, more than 40 countries came, critically, including a lot of the Global South and China and India. This was, the ambition was relatively low. They weren't trying to get a deal. They were simply trying to kind of catalyze, get people to sort of be around the table and start talking about something. Russia was not there. For the Ukrainians, this was progress. They got the Chinese around the table. They got people to sort of discuss with them. Russians not there again. So for them, it was a kind of progress, but it also didn't move anywhere. There's no common statement. So it does underscore just how difficult it is going to be still to get the two sides to agree to anything where they come to terms, because they're both fighting it out on the ground right now.
Mark, thank you so much, as ever, for all of your reporting. Our Bloomberg senior reporter for international affairs, Mark Champion. Now, coming up, Nigeria's junta partially closes the country's airspace. Well, let's get the latest on this developing story. We'll do that next, and this is Bloomberg.
Say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio. Your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Niger's junta partially closed the country's airspace, warning of an attack by a foreign power as the deadline passed on Sunday to reinstate the ousted president. Bloomberg's Jennifer Zabazaja now joins us from our Johannesburg bureau. So, Jen, thank you for joining us. What's the latest here?
Yeah, Fran, I mean, what we were really waiting for was what was going to happen on Sunday, yesterday, because that was the deadline set by ECOWAS for Niger, the military leaders there, to reinstate power. Of course, we didn't see that. That's why we are talking about this right now. And really what we're waiting for is what's going to happen next. As you mentioned, we did hear from the military leaders supposedly claiming that there was some sort of military intervention operation that was supposedly coming together within two Central African nations. We don't have any reporting on that at this point in time, but as a result of that, what we did see overnight is that these military leaders did close airspace, and that's already having an effect on a number of international airliners. We're hearing reports about some flights that are actually having to be diverted away from the country, coming from Johannesburg to London because of this reason. And so now what we're waiting to hear from is what the ECOWAS leaders are going to do. Their plan, and initially what we had heard from them was that they were planning a military intervention. Now it remains to be seen whether or not we're actually going to see that follow through.
So, Jen, what needs to happen in order for the tension to actually ease at this point?
The tension only heightened over the weekend, unfortunately. You were just, I think, looking at pictures of a rally that we did see in Niamey, which is Niger's capital, of thousands of would-be or reported supporters of these coup leaders gathering together. We did see the coup leaders there, and we heard from a few of the coup leaders actually trying to encourage young people to be on the defense if military intervention were to, in fact, materialize. But on the ECOWAS front, we're waiting to hear what leaders have to say. From the ECOWAS chair, the Nigerian President Bola Tinubu, we really heard that they wanted this to be resolved through diplomacy. They wanted any sort of reinstatement to democracy to be in a peaceful manner, not within military intervention. And so we need to see really how these leaders plan to move forward. With previous coups in this region, we saw similar actions taken, deadlines set by ECOWAS, but not the threat of force. So we're unclear whether or not they're actually going to follow through with that and what's going to happen now. But it seems like what many of the leaders want to see is a peaceful resolution and diplomacy to return power back to President Mohamed Bazoum.
Jen, thank you so much. Our very own Jennifer Zabazaja there in Johannesburg. Now, here's what else we're watching this week. On Tuesday, the ECB releases its consumer expectation survey. On Wednesday, then, we'll get China CPI and PPI. Later in the day, we'll be watching the Disney earnings. And then on Thursday, it's, of course, U.S. CPI. The prior month's report showed a rise of 3% from a year ago, which is the smallest increase in more than 2 years. And then at the end of the week, we also get UK GDP and U.S. PPI. Now, this is a picture across the board for European markets. A lot of the focus is in what's happening in the short-term German bonds. Now, they rose as the central bank also said it would stop paying interest on domestic government deposits. That means there's a dash for higher yielding yields. I'm also looking at wheat prices. So it's a good time to look at wheat prices rising after a drone attack on Russian oil tankers prompted a fresh wave of missile strikes by Moscow over the weekend. And then, of course, the big one that we're watching is the U.S. two-year. But in general, it's Treasury yields. Actually, for the moment, they're advancing, reversing some of Friday's decline when the interest rate-sensitive two-year yield and the 10-year yields fell more than 10 basis points after U.S. payrolls come in below estimates. Remember, the concern is that there's a lot of issuance over the next 10 days, actually over the next 6 days. So watch out for Treasuries. The other story that we're extremely interested in is Siemens. Siemens Energy launching the strategic review of its wind power business as problems with its turbines are expected to cause a €4.5 billion net loss in one of the industrial Germany biggest debacle. So we'll continue watching the debacle, and this, of course, comes also in a worsening outlook compared with the previously roughly prediction of $1 billion. So that prediction of a loss became 4 times bigger, and you can see Siemens down 1%. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger here in London, and this is Bloomberg.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. It's a tepid start for markets as Fed officials debate further rate hikes ahead of this week's inflation report. Governor Michelle Baumann warns additional increases may be needed. Meanwhile, in Europe, German factories are enduring extended weakness at the Bundesbank, surprises markets with a deposit cap. And wheat jumps as Ukraine's drone attacks on shipping puts Ukraine and Russia's commodity exports at risk. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, it's quiet for now, but it's a big week for U.S. CPI and for U.S. Treasury auctions.
Yeah, we're already seeing a little bit of green on the screen, Danny, which is interesting given how much could change in the bond market over the next few days, to your point. But what's interesting to me is even for the equity market, already seeing elements of breadth throughout that pre-market trade. And it's important to keep in mind as well, when you look at that kind of green on the screen, it is by a slightly higher margin than usual. Futures higher by 0.3%. The Nasdaq's looking about the same, 45.12 on those contracts for our radio audience. But again, I think the bond market is the real story here, Danny, because already a massive move in the two-year yield this morning, almost 8 basis points higher, 483 on the front end of the curve. And a lot of that is coming out of Europe. I'm going to let you explain that to our audience in just a moment. But we'll also have our eye on the FX story. Of course, dollar yen remains in focus. This is the first time in 4 sessions you are seeing yen weakness again. So it has a little bit of a run when it comes to the kind of repercussions of the BOJ and what they're thinking in terms of the inflation front in Japan. But at the moment, dollar yen 142.30, strength in favor of the greenback, higher by about 0.4%. Of course, as we talk about a stronger dollar, the ripple effects are going to be mostly felt in the commodity complex. We're going to dive into this in a little bit, but at the moment, broad swaths of the commodity market down to about 0.3%, Danny.
I got to say, you want me to explain the European picture for bonds? It's not totally clear. There's a lot of cross currents here, so I'll get to that. But first, probably we're starting with European stocks because it's been a really volatile session. I mean, volatile is relative. We haven't seen huge changes, but volatile in the way that we just can't find direction. European stocks opened down, then they went up. We're back down now. Not a lot of earnings to really base anything off of. We've only gotten 2 in the stock 600 today, so that's not really going to move the needle. Perhaps what we're seeing is just a reaction to a negative session on Friday from the U.S. It's kind of hard to shake some of those summer doldrums when a lot of people are away from their desk to really change things up. When it comes to the bond picture, Kriti, you mentioned this. 2-year yields are actually doing something different in Europe. 2-year yields are falling. There is a bid for it. But again, I wonder how much of that is just following on from what we're seeing, what we saw rather in the U.S. session on Friday, or does it have to do with what's happening in Germany with state deposits, again, changing and what's given back with that? We're going to talk to Simon White about it in just a moment. And I just wanted to point out the euro. For all the expectations that the consolidation was over for the euro, it's still weakening, Kriti. It is weaker by about 1/3% versus the dollar.
Well, let's go back to the bond story here, because this is going to be something we talk about for the rest of the week with that CPI number and, of course, the issuance wave that we are expected. In the meantime, Fed Governor Michelle Bowman also saying more hikes may be needed. That comes after Friday's mixed jobs report. The focus now turns, as I was saying, to that inflation print story coming later this week. Take a listen, though, to what Chicago Fed President Austin Goolsbee had to say. Well, it is insignificant when we talk about kind of what the thought process is. Sadly, we have some technical difficulties. We can't get to the thought at the moment, but we will bring that to you when it's ready. And let's get straight into the analysis here. Bloomberg macro strategist Simon White joins us. Simon, we're dealing with a lot of cross currents in the bond market, like Danny just talked about. She explained the European story, but I want to start with the U.S. one, specifically when we're talking about how you trade an inflation print that could very easily come into contradiction with what we saw in the jobs report on Friday. What do you do here?
Yeah, it's very tricky. I think the market will obviously be alert for higher prints. So the CPI fixing swap market is probably in the shorter term, over the next, say, 3-4 months, probably the best kind of read on what inflation prints are going to be. It's basically, this inflation traders that have to try and figure out what this is going to be. They've got skin in the game. So I think they tend to have a very good handle on what this number is going to be. So 3.3. I think is what's expected for the headline number, and that's not far off where the CPI swaps are. So if it is significantly higher, though, because of what we've seen over the last week or two, that's probably going to be an issue for the market, purely because, as I say, people are now much more alert to inflation risks. And I've talked about this quite a few times before. I think there's a risk that the market's not fully priced of a re-acceleration of inflation. I don't think you're necessarily going to see it, as I say, in the next 2 or 3 months, but further out into the later this year, early next year, I think it's a distinct possibility. I think that's something that's really not been factored in properly by the market yet.
And last week, we did see some significant curve flattening in the U.S. When you look at the German bond market, it's doing the same thing. The front end of the curve, yields are coming in, I was just pointing out before, by about 4 basis points. How much of that is about Friday's trade in the U.S., where we saw that happen with treasuries, versus some of what we heard out of the German government over the weekend on Friday, saying that they're not going to be paying interest on state-held cash anymore?
Yeah, I mean, I think probably the biggest influence is the relief rally after the sort of slightly softer jobs print. I mean, the jobs numbers, I think, is very interesting. 2 things to watch are temporary hours worked and temporary services. Both of these are very good leading indicators of the jobs market. Both of them are continuing to deteriorate. So the market, was already very oversold, and we saw a rally. The German thing, I think, is very interesting, more from a slightly longer term perspective, because it's now going to be more politically contentious. You've basically now got central banks are having to, in a super abundant reserve system, they're having to pay a lot of money to banks because you have all these reserves and you have interest rates that are now well above zero. So this is something that's going to be not just in Europe, but in the US and the UK and other countries too, where they're going to be under much more scrutiny, that they're paying tens of billions of dollars or euros or pounds to banks. So, what Germany's done is something I think that's going to be under the spotlight as we go through this in other countries as well.
Simon, let's stick with the Germany story here and get to the economic data. The industrial heart of Europe now seeing output dropping to a 6-month low. How do you factor that into the story as well?
Yeah, I mean, look, Germany's flirting, but, it was in recession. Is it out of recession? I mean, the last quarterly GDP print was flat. Maybe that gets revised lower. A lot of the leading data still points to, you know, it's a very fragile German economy. Obviously, the German economy is the most important part of the European economy. Italy is flirting with recession as well. So I think, of course, this factors into the bond yields. But I think in Europe and in the US, it's the same thing. This is not really a garden variety recession. We're having a recession with inflation. And that's not really something that markets have had to deal with. And in that environment, I don't think you can expect bonds to do as well as they would normally do in an inflationary recession. So, you know, you are going to get some sort of rally. I think that's a knee-jerk reaction. But if we have persistent elevated inflation, which we're, you know, seeing several signs of across the, Europe and the US, then I think you have to factor that in, and that means that yields might not behave in the way that you expect them to.
Yeah, more reasons to get caught wrong-footed in this market, as if there haven't been enough of them for the past, 3 years?
Exactly. Get used to it.
Yeah, exactly. We should be used to it by now. Simon White, thank you so much. All right, let's turn to geopolitics in Ukraine. Now, over the weekend, tensions escalated in the Black Sea as Ukrainian sea drones crippled Russian naval vessels and oil tankers. For more, Bloomberg senior reporter for international affairs, Mark Champion, joins us now. Mark, to what degree does this represent an escalation, not just necessarily in intensity, but geographical footprint of this war?
Yeah, that's exactly what it is. We've seen Russia really sort of up the ante in the Black Sea since they pulled out of the international grain deal in July. And since then, they've been hitting Ukrainian ports and infrastructure, the grain infrastructure. And literally what the Ukrainian Defense Ministry said over the weekend was two can play at that game. And that is what is now happening. And the Ukrainians have hit, as you said in the introduction, they hit a naval vessel, and they also have hit an oil tanker. So, given the amount of grain that goes through the Black Sea, virtually all of Russia's grain, whatever, Ukraine can now export, most of it goes through the Black Sea. And then about 15 to 20% of Russian oil plus Kazakh oil. So, it is we don't know exactly, where this will lead, but it is a significant escalation of the war's footprint.
So break this down a little bit for us in terms of the Ukrainian cities, perhaps in the line of fire here, quite literally, Odessa, Mariupol, et cetera, the significance, Mark, when they come to those grain exports.
Right. So, so on the Ukrainian side, you have the three ports that were included around Odessa, and they were included in the grain deal. So they were allowed to operate to a somewhat restricted extent, but they were allowed to operate. The Ukrainians, in the meantime, had been really rapidly expanding the capacity of ports on the Danube River, which were able to kind of circumvent the Russian blockade of the Black Sea ports. So the Russians are now hitting both. They've hit the ports on the Black Sea that were involved in the grain deal, which is now over, and they have also hit the ports such as Izmail and Reni, which are on the Danube, which is, very tough for the Ukrainians. This is an important part of their economy, but it's also tough in terms of, grain markets, because you're taking grain off the market, destroying silos, etc. On the Russian side, the main port that we're talking about here is Novorossiysk. And that one, that's where the naval vessel was hit, just outside Novorossiysk. The port was briefly closed. You've got about 2.5 million barrels of oil that exit through there and in the Black Sea more generally. It's an important channel.
It's certainly something we're going to be watching very closely. Bloomberg's Mark Champion walking us through those developments. And as he spoke about oil and wheat, it's worth getting a quick market check on those, because you are seeing wheat higher by about 2.3% this morning. But as Danny reminds me, a 2% swing in either direction is pretty common for that commodity. In the meantime, you are seeing oil pull back a little bit as well. We will keep you apprised of all of those moves at the moment. Right now, we're going to stick with commodities as well. Saudi Aramco joining big oil and boosting its dividends by more than half to over $29 billion, despite a drop in quarterly profit. Bloomberg's Anthony DePaolo, who covers Middle East energy markets, joins us now from Dubai. Anthony, pleasure to have you on the show. Walk us through these earnings.
Good morning. Yeah, this was a big drop in the profit. while they did increase the dividend. And that's kind of following the rest of the industry. We've seen the oil majors coming out through this earnings period, showing us net income down, but the payouts to shareholders up, either by the dividend or by share buyback. So Saudi Aramco, is continuing in that vein. Really, it was a story of supercharged oil prices last year after that Russian invasion of Ukraine pushed up all commodities. They've come off, and we've seen those down in the first half, which has really hurt the earnings. Add to that the OPEC Plus production cuts that the group has been using to try to stabilize the market, and that means Saudi Aramco has been selling less oil at a lower price, so that's going to hurt the earnings, of course. But this move on the dividend, that's the big news that we're seeing out today. That's going to help underpin some of the Saudi government budgets, which were potentially facing a deficit this year on that first half weakness. That's going to shore up the Saudi coffers, and it's also going to try to help attract some of those investors from some of those majors who are looking for some dividend yield. And the CFO, talking to reporters today, was saying they're getting out of kind of viewing Aramco as a bond rather than a stock, and they're looking at as a growth stock. So they're really working on that dividend, on the one hand, to shore up the government and bring in those investors.
What did you make of Aramco's outlook moving forward, especially with those production cuts in mind?
Yeah, CEO Amin Nasser, again talking to reporters, was saying that he's seeing some positive signs coming out of out of China, which is their major market. He says that there's a lot of room left to go in terms of the recovery there. And that's one of those things that's been a little bit sluggish so far this year, that a lot of producers, a lot of traders have been looking at as the real key to get oil markets back on their feet and back moving more quickly. We haven't seen that in the first half. Now, with those cuts that I mentioned before from OPEC Plus, from Saudi Arabia unilaterally, that's brought oil back to where we were pretty much at the end of last year, so wiping out the losses that we saw in the first half. And now we're going to need to see some of that China aspect come in, and that increased demand along with those cuts is supposed to tighten the market in the second half. So we should, if that happens, see some of those oil prices continuing to rise up. Those are the forecasts that we're seeing now.
Okay, Anthony, thank you very much for that roundup of Aramco earnings. Anthony DePaula there with the latest. Now, coming up this hour, we're going to be catching up with Jitesh Kumar, SocGen equity and cross-asset derivatives strategist. Ask why the VIX is just so low despite some of the other volatility. But first, up next, we're going to bring you our exclusive interview with Israeli Prime Minister Benjamin Netanyahu.
I hope that we don't get into a constitutional crisis. I think we won't. I think there's a way of reaching an equitable compromise, which is what I'm trying to do.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Welcome back to Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Israeli Prime Minister Benjamin Netanyahu says that we're about to witness a pivot of history with Saudi Arabia. He spoke exclusively to Bloomberg about the economic potentials for Israel and the potential of working with Saudi Arabia and the Palestinians.
Saudi Arabia, I think, is one of the exceptional things that tells you why I'm very optimistic about Israel. Really one of two reasons, one of two main reasons. One is that, well, I'll start with Saudi Arabia, but then I'll get with the other one. Yeah. I think that we're about to witness a pivot of history. Maybe. I can't guarantee that it'll happen. But first, there is an economic corridor of energy, transport, and communications that naturally goes through our geography, from the Arabian Peninsula, from Asia to the Arabian Peninsula to Europe. We're going to realize that. Yeah. And by the way, my sense is we're going to realize that despite whether we have formal peace or not.
But do you have to give concessions? So we understand Saudi Arabia. So what would you give? Would you limit, for example, Jewish settlements in the West Bank?
Again, you have a good penchant as a good journalist to try to eke out from me my negotiation stance, and of course you're not going to succeed, but you could keep on trying. But do I think it's feasible to have that? And do I think that political questions will block it? I doubt it. If there's political will, there'll be a political way to achieve normalization and a formal peace between Israel and Saudi Arabia.
Prime Minister,
that has enormous economic consequences for your investors. And if they have to bet on it right now, I'd bet on it, but I can't guarantee it.
And Prime Minister, this is why I'm not trying to ink out negotiation taxes. I'm trying to understand what you're willing to give, because this is such an important partnership.
Well, I'll tell you what I'm not willing to give. I'm not willing to give anything that will endanger Israel's security. That I will not do. But I think there's enough room to discuss possibilities. I don't think, I think the Palestinian thing is brought in all the time. It was always brought in. And it's sort of a checkbox, you have to check it to say that you're doing it. Is that what is being said in corridors? Is that what is being said in discrete negotiations?
I don't know, you tell me. What's being said?
The answer is a lot less than you think.
Okay, so if you look at, for example, giving the Palestinians their own state, is that something that you would, is that a red line?
It won't be their own state. It'll be an Iranian-controlled state that will, in an area that is about the width of the Washington Beltway. If you take Israel and the Palestinian areas in Judea, Samaria, and the West Bank together, it's a little more than the width of the Washington Beltway. You put a Palestinian state, which will be controlled by Iran, in half of that, or in the middle of that, you won't have a Palestinian state. You'll have an Iranian terror state. And
so that's a no.
Of course, it's a no, yes.
So under no circumstances would you allow that?
No, what I said often is that the way that I would have a solution is two things about that. One, that the Palestinians should have all the powers to govern themselves and none of the powers to threaten Israel. This means that in whatever final settlement, peace settlement we have with the Palestinians, Israel remains I would say Israel has the overriding security power in the entire area, ours and theirs. Otherwise, we collapse. They collapse.
The Israeli Prime Minister Benjamin Netanyahu there. Now, coming up, Morgan Stanley's Mike Wilson is bracing for disappointing growth in the U.S. We'll have the sell side latest for you coming up. This is Bloomberg.
decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now to the sell side, where J.P. Morgan's chief U.S. economist Michael Feroli says that he's no longer expecting a recession in the U.S., which had previously said it expected a recession to begin in 2023. But now the bank sees continued expansion this year and modest subpar growth in 2024 is the most likely scenario. Now, on the other side of things, Morgan Stanley's Mike Wilson says investors should be ready for potential disappointment on economic and earnings growth. Kriti, I kind of get why Mike Wilson is saying this. You can say all you want about his bearish calls not coming to realization, but he calls out the fiscal expansion we've seen. Think about the Inflation Reduction Act, things like that, and said that tightening would reverse that. It would be a risk for the equity market.
And look, he's got a point, and so does Michael Feroli, to be completely frank. When you are starting to see this slowdown in the economy, there is economic data that supports it. The problem is the deceleration just isn't as fast as expected, and this is very normal in an economic cycle. You are going to see a deceleration, but it happens over the span of years, not quarters, as I think we were previously expecting. So the resiliency of Feroli's call makes a lot of sense, but so does the slowdown of Michael Wilson's. Two things can be true, Danny.
Yeah, and we should point out it's not just J.P. Morgan. Last week, Bank of America also capitulated on their recession call. But again, I can't help but wonder how much of this is about fiscal expansion. Now, we're going to hear from the man himself. Mike Wilson from Morgan Stanley joins Bloomberg at 8 a.m. Eastern today. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A tepid start for markets as Fed officials debate further rate hikes ahead of this week's inflation report. Governor Michelle Bowman warns additional increases may be needed. Meanwhile, in Europe, German factories are enduring extended weakness as the Bundesbank surprises markets with a deposit cap. And wheat jumps as Ukraine's drone attacks on shipping puts Russia and Ukraine's commodity exports at risk. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest. Geopolitics at play, of course, monetary policy at play, but I think right now everyone might just be in wait-and-see mode for the CPI figures tomorrow.
I thought you were going to say right now everyone might be on the beach, which is probably true, too. And I think that's for the reason here. I mean, I know you and I both wish we were. Just kidding. We, of course, want to be here with you, all of you watching at home. Look, for European equities, it does feel like we're just unable to shake off of what happened on Friday. I should say for all of these markets in Europe, we're unable to shake off the Friday markets just because we are in the middle of the summer, the kind of edgy markets where there's no catalyst, at least for today, to really turn things around. We're also really light on the earnings front. We're more than 80% through the earnings season in Europe. So European equities are falling again, like what the U.S. did on Friday. Meanwhile, the euro, we thought that we'd see the end of consolidation. We're not there yet. The euro dropping, weakening versus the dollar, down about 1/3%, perhaps in reaction to Michelle Bowman talking about the need of more rate hikes. And finally, the front end is getting a bid here in Germany. Now, at the back of last week, in the whole of last week, we saw this really extreme steepening in the curve. On Friday, we had the jobs report. You did see a relief rally. And it's likely, again, what we're seeing in Germany, Kriti, is just a catch-up because European markets were mostly closed when that happened. So bid into the front end. Yes, we got some changes on deposit caps for German government holdings, but that's more of a long-term story. So for now, it's kind of, again, the polar opposite of what we're seeing in the U.S. just because we have catch-up to do, Kriti.
Yeah, I was literally just going to say that. You are seeing the exact opposite in the U.S. stateside. Green on the screen, actually, when you look at the equity market here, by, I think, a significant margin for about 5:30 a.m. New York time, up about 0.3% on S&P contracts, 45.13 for our radio audience there. The bond market, though, gets interesting. And actually, before I get to that, I want to mention quickly that the stock market is seeing very broad gains this morning. So that could be a positive as we enter those opening bells. The two-year yield, though, 4.84 is what I'll call it there, higher by about 8 basis basis points. So already seeing a real sell-off at play in the bond market. You go further out into the curve, you are seeing the same dynamic. Now, ordinarily, you would think that the volatility in Europe might be sleeping in, but a lot of those questions that you had in terms of Michelle Bowman, for example, calling for additional rate hikes, the anticipation of a CPI report tomorrow, it's all going to factor in to the bond market story this morning. Nevertheless, 484 on the 2-year yield. Of course, we talked about the bond market. We have to talk about the strength in the greenback because specifically against the Japanese yen, you are seeing that 142.24 on that currency pair, stronger by about 0.3%. This is significant because this is the first session after 4 consecutive sessions of strength in the Japanese yen that you are now seeing a little bit of a pullback. So that's going to be a currency pair we're going to keep an eye on. And of course, with that dollar strength, with those higher yields, the ramifications are going to show up in the commodity market, especially as we get those headlines out of Ukraine and Russia. Bloomberg Commodity Index broadly lower, though, down about 0.2%, Danny.
You mentioned volatility throughout that, Kriti. Let's look at what volatility is doing, options-based volatility, because despite the longest losing streak for American equity in about 3 months, despite a day where we saw U.S. stocks fall by more than 1 1/3%, equity volatility, the VIX specifically, has been very subdued, still below 20 despite a move index, despite bond volatility that has picked up. Well, our next guest has been calling for lower volatility this year. He's nailed that call. Let's bring him in. It's Jitesh Kumar, equity and cross-asset derivative strategist at SocGen. Jitesh, really great to speak with you today. Okay, what would it take to wake up slumbering equity volatility? Is there anything on this horizon that could do it?
Thanks for having me, Danny. Yes, of course. I mean, we can have volatility from various events, but fundamentally speaking, I think U.S. equities and global equities have been in a very good place. The profits have kept up. We are near 50-year highs in profit margins. So the reason why we've been calling for lower volatility is because corporate sector broadly has been doing very well. So we haven't had the reason to have higher volatility because profits in general are negatively correlated with equity volatility. So higher profits automatically mean negative volatility, lower volatility. Now,
right, and Jitesh, if I can jump in here because that's actually what I wanted to get into. So this is perfect. It's bound to change next year. What's going to change that again, especially if we've seen a lot of the positioning being that trade to pick up pennies in front of the steamroller? This is not a market prepared for more volatility.
Yes, I think there are 2 aspects to it. One is the fundamental reasons why volatility goes up, which is the health of the corporate sector, the broad-based economic backdrop. Whereas the second thing we should also look at is the positioning, which changes from time to time. So I think these 2 often interplay with each other. Right now what we have is the health of economy has been good, so that's why vol has been fundamentally going lower. Now what we are seeing is positioning starting to get into lower volatility. So basically people are starting to sell vol. It's already been happening via options. So just to give you an example, right? If you are short vol, one variance swap on the forward space, you have 4 or 5 vol points of pickup at this point, which is the maximum you've had, let's say going back 4 or 5 years. So the conditions are very favorable for the short vol trade, which is why it's likely that we see more inflow into this. But eventually, I think when fundamentals take us in the other direction, things change slowly. It takes time. Now is not the time. We think there is at least another 3-4 months. And till the end of year, I think vol will remain low. That's our base case.
Jitesh, let's move a little bit to the bond market here and really zero in on there, because if we're talking about the wave of issuance we're expecting this week, I think there's a lot of questions in the market about just how much the bond market is going to be able to digest that, especially given we're already seeing about an 8 basis point move higher in the front end of the curve in the U.S. this morning. How does that square with some of kind of the VAR shock risk that you might see play at the market? Square the 2 for us.
Yes, I think that's a very good point. And honestly, VIX has picked up from the low 13s to about 17 right now because of this. So bond market volatility does feed into equity volatility to some extent. But I think the big mistake that investors make is to expect a one-on-one translation from bond market volatility to equity vol, which doesn't happen at all. I'll give you an example. So if you look at the total interest cost of the corporate sector, it has changed by it has actually fallen by 22% since 2021, whereas the sovereign interest that the US government pays has gone up by 76%. So we've had a divergence between what the health of the corporate sector and the health of the US government. So it's no wonder that bond market volatility is going up. Now, you're right that technicals do play a role, and if you have a VAR shock, some people have to mechanically offload positions. But again, if you have a fundamentally favorable backdrop, I don't think that the technicals can override that to a large extent. For example, even in Volmageddon, right, in 2018, when we had this huge flow-based move, I think we didn't really we went back to a VIX of below 15 in June, July. So I think we need both fundamentals and technicals to turn bad for vol to really pick up from here.
I mean, isn't that the dream, though, to have technicals and fundamentals work in the same direction? Jitesh, when it comes down to it, you also have to square in monetary policy. To your point, do you start to see the plumbing take precedence over what, say, Jay Powell might be saying?
Again, I think this is, in the volatility space, especially, you know, hedge funds and lots of technical players are basically, they base their flows, their trades on the flows. And I think we need to take a longer term view of things and look at the fundamentals, because if we don't have, as you said, if both fundamentals and technicals don't align, then we don't have the best conditions for trade. So right now, you're right, fundamentals have been great. The thing is, technicals are now pushing vol lower. Very soon, fundamentals will start to move in the other direction. So maybe now people trying to buy vol is still a bit too early in our view. What we are interestingly seeing is lots of people pulling back their recession calls. I think we will have some payback next year because we've had a huge move lower in rates since 2019, since COVID, and now it's been 12 months, 15 months since the Fed has been hiking rates. I think we need more time. There's a very classic example that I give. For example, if you're cooking something in the oven, right, you can either raise the temperature or you can you have to keep the dish in for, let's say, an hour. Now, you can't take the temperature to double the temperature and say, okay, I'll only cook it for half the time. That doesn't work. So monetary policy really does need time to pass through to the whole economy. And I think you cannot really fight that. That's the way it works in the markets.
Jitesh, little did we know, not only were we going to get a great view of the market, but also fantastic cooking advice, too, because I feel like that's a sin I might have committed. Look, we're related to what you were saying in response to Kriti's question about the bond auctions. Part of the reason we've also seen volatility further out on the curve, further out in duration, is because of the unanchoring of the BOJ, or at least the expectation we're going to get some unanchoring in yields. What have you seen in terms of changes in pricing around duration volatility, and what do you expect to come in terms of the BOJ's impact?
Yes, I think that's a good point. So, for example, in 2022, when bond volatility was high, NASDAQ and long duration sectors had the highest volatility, and that fed through because it's a big part of the US equity market. So I think it shows up in volatility. So whatever the BOJ does has a big impact on the margin. And I think what we need to do is be careful of duration risk here, because we may have some more volatility in the long duration sector of the market because of that, because of higher issuance as well. However, I think there are ways to get around that. For example, one trade that we've been recommending is, and our Asia equity strategy team has been quite ahead on this as well, is Japanese banks, which have done really well. And every time you see a rise in the Japanese bond yields, this is a sector which does outperform. So I think it's one of those things where you have to diversify into different kind of assets, not be careful of your duration exposure in this environment as well.
So positive on Japanese banks and positive on the short vol trade. SocGen's Jitesh Kumar joining us on Bloomberg Surveillance Early Edition this morning. We thank you as always. Coming up on the program, shares of Berkshire Hathaway higher in the pre-market as the firm posts strong operating profit backed by its insurance business. We're going to walk you through it. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Shares of Berkshire Hathaway rising in the pre-market after Warren Buffett's conglomerate posted gains in operating profit driven by strength in its insurance business. Shares higher by about 1.5% this morning already. Let's bring in Sonali Basak, our global finance correspondent, to break us through it. Walk us through the earnings story for Berkshire.
Yeah, for somebody who had warned that things could get rough this year, the earnings are looking actually pretty good, particularly in that insurance business where there have been a lot of questions about competition. Listen, the top line also grew as well as the bottom line because they had a lot of expense control. Our colleague Max Reyes over at Bloomberg points out something interesting here is the policies in force were actually kind of below what you would want there to be at GEICO, given that they have reduced expenditures on marketing. However, you are still seeing healthy results over at the insurance company, which is, of course, a massive business at Berkshire. I would also say that despite its very large cash hoard, the market's up. The net unrealized gains here for their investment portfolio are also pretty significant, especially because it's been holding the likes of Apple, which did very well through the first half of the year. Well, Sonali, as you yourself mentioned, I mean, last time we heard from Buffett in Omaha earlier this year, he was warning about this downturn, especially in the economy. Did we see that play through in any parts of his businesses? Yeah, we certainly did, and that's the railroads, utilities, energy businesses. If you looked at kind of the comparison side by side next to those insurance businesses across from the railroad businesses here, the costs rose much more dramatically over at those real economy businesses than they did over at the insurance company, where we have been saying that he is cutting costs. So that was one of the big differentiators when you looked at the profitability, but there was also pressure on the top line relative to the insurance companies when you looked at those real economy businesses.
So I want to go back to the cash hoard question in particular, Sonali, because if you look at the S&P 500, Berkshire Hathaway is the 10th largest, call it ninth largest company, top 10 companies in terms of market weight when you look at the S&P 500. If you have a massive cash hoard or even a declining one, that's going to have real market ramifications. Walk us through why that's so significant here.
Yeah, it's an interesting dynamic for Berkshire Hathaway because you're investing in Berkshire, you're investing in all their businesses, but you're also investing in their investment portfolio. And they have a massive amount of treasuries. We had Berkshire and Buffett last week come out and saying that this fiscal downgrade is not a big deal, but he's mostly talking about that short end of the curve. And that dynamic relative to where you're seeing the 30-year go today, I think, is a very interesting question. One other story we have on the terminal today is about hedge funds kind of utilizing the basis trade at a greater scale. And when you're doing that and arbitraging the longer dated securities versus the shorter ones, if there are any hiccups in the future, I think that's kind of the thing I know I have my eye on, I know the banks have their eye on, and would be the one thing that kind of would throw Buffett's kind of thesis out of whack here. Yes, which is always why when we look at CTFC data, which showed hedge funds at a record short on bonds, we should always remember that basis point trade, Sonali. Look, elsewhere on the terminal, the most read story over the past hour is that UBS will be cutting 2/3 of Credit Suisse bankers in Asia. Sonali, what's this all about?
There are a few things here. Remember, we have reported previously that UBS wants to keep more than 100 bankers out of Asia from Credit Suisse. But the real thing here, Danny, is there's a ton of overlap when you look at the investment banking base in Hong Kong in particular between UBS and Credit Suisse. So what are they going to be trying to keep? Perhaps more bankers outside of that Hong Kong region. Both banks have been tremendously strong in that region, very high-level underwriters in that region for high-flying tech companies. They obviously have very large wealth management presences in the country as well. But when you look at what UBS may look to keep, it's more along the lines of what you're seeing in India and Singapore. India is a place that they had wheedled down on their presence years ago, and the opportunity to bring Credit Suisse on expands their base across Asia, especially India being such a kind of robust area for capital markets as of late.
And on top of that, when you go to Asia, they're also then cutting costs there too and jobs there as well. But that's more on the Credit Suisse side, right?
Yeah, and that's where the overlap issue comes into play. The reality is UBS already has a lot of bankers in Hong Kong. And so while these job cuts are certainly unfortunate for the job market, one of the central theses for this merger is this idea that they can be more profitable at the end of the day because there's a lot of synergy. There is a lot of overlap that we've known they're going to have to get a handle on.
Okay, Shonali, thank you very much. That's Shonali Basak walking us through the Berkshire news and the banking news. All right, quickly, just want to mention we've been covering bond yields falling in Germany on the front end. Some more fuel to that. We just had a 9-month bill auction in Germany. It saw its highest demand since February of 2022. It's not just about the U.S. trade on Friday. A lot of it was about that in terms of the market moving to the short end, selling off duration. But Germany also changing, the Bundesbank changing how deposits will be handled. You're not going to get interest payments off the back of that. It's really encouraging folks to not buy duration, to not hold their money with the Bundesbank, but instead to be buying short-term government bonds. So that's what we're seeing. Yields on the 2-year dropping about 2 basis points. Again, that strong demand for the 9-month bill auction in Germany. Okay, coming up, a look at some of the market-moving events that you need to know to get your week started. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, have fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, Kriti Gupta is in New York. Now let's get you set up for your week and your day. Here's a look at what's ahead. We're going to be getting German CPI and SoftBank earnings on Tuesday. Then CPI and PPI out of China. Will we see that disinflation coming through continuingly? And Disney earnings, those will be out on Wednesday. U.S. CPI, that's the big one, and jobless claims. Plus earnings from Alibaba are out on Thursday. And then we're going to be rounding out the week with U.S. PPI and UMich consumer sentiment. UK GDP, France and Spain CPI are all out on Friday. So a lot in terms of data. Plus, it's worth mentioning that the Treasury is going to be selling more than $103 billion in longer-term Treasury auctions this week. Kriti, this is what's going to kick off a quarter of higher auctions from the Treasury Department in what Fitch warned about, and a lot of people coming out and warning that the growing deficit is now something to be concerned about if you're trading in these markets.
Yeah, and at its core, of course, is going to be exactly what our previous guest, Jitesh Kumar over at SocGen, was talking about, how much the market can actually digest this at a time when you're already seeing yields really jump this morning, Danny. I mean, I'm looking at a 2-year yield here that's already higher by 8 basis points, and again, is only about 6 a.m. New York time. I do want to go from the bond market to the stock market, though, because there are a few stories there as well. Berkshire Hathaway, their Class B shares inching closer to their all-time high. This, of course, coming after their earnings story, higher by 1.5%, and we just had Sonali Basak, our global Wall Street correspondent, walk us through those numbers. The cash hoard is significant, as is their insurance business. Now, if you're thinking about slowing down, a slowing economy, an insurance business isn't necessarily going to be thriving, and yet here we are seeing that pullback, and yet Berkshire Hathaway doing fairly well. But the weakness coming in those perhaps more economically sensitive areas, the railroads, the utilities, et cetera, nevertheless higher by 1.5%, Danny.
And I think it's remarkable because, as we were talking about with Sonali, it was just in May that they had their annual meeting in Omaha that Warren Buffett, was saying that, of course it was him, saying that the incredible period for the U.S. economy was drawing to an end. Now, perhaps he still believes that, and perhaps that's why things like railroads underperformed. But still, if you want a lesson in how to guide down this market, Buffett has done a great job of that.
Yeah, and I would say not just Buffett, but Charlie Munger as well, who of course has been by his side for ages and ages, also kind of beating that drum as well. Danny, I want to bring another stock to your attention. Monster Beverage in particular, MNST, seeing a lot of heavy volume this morning, which is interesting because it's really just on an analyst upgrade. Piper Sandler upgrading to overweight from neutrals, coming off their second quarter sales numbers. Despite that margin miss, nevertheless, you are seeing higher by 3.5%. Their price target being raised to $63 from $60. Let's zoom out though for a second, Danny, because this has been a theme among a lot of the beverage makers. You've seen it with Coca-Cola, even Pepsi.
I'm just still thinking about alcohol, not to drink alcohol, to be clear, but some of what we've heard in Europe. Yeah, it's too early for that. But in terms of what we've heard from the makers, a lot of spotty earnings. We saw Heineken do poorly, AB InBev do well. So for those consumer stocks, it's been a mixed picture.
Yeah, it's certainly something we're going to be keeping an eye on, especially when a lot of the dollar story is going to start feeding into essentially these multinational corporations around the world. Well, look, that does it for Early Edition. More stock coverage, more bond market coverage. So surveillance is ahead. Morgan Stanley's Michael Wilson joins the program at 8 a.m. Eastern this morning. Stick with us. This is Bloomberg.
brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
What we really need to see is whether or not the slowdown is intact.
We're still seeing some lingering effects of the pandemic.
We think that we are on that path to get to lower inflation by the end of the year.
The hawks from the Fed are really going to focus in on the wage growth.
It's going to be difficult to see rates coming down in that way that they did in the last 15 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Following the biggest one-week drop since March on the S&P 500, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500, slightly positive to kick off the trading week. We are positive 1/3 of 1%. TK going into CPI on Thursday, PPI on Friday.
And that's right where I want to go, John. Inflation, I think, is the key dynamic here. And over the weekend, it was an odd weekend. And I really want to bring this up front and center. It's in the zeitgeist. Bloomberg reports on bond prices up in China and yields down. But into the inflation reports that we see later this week is this tinge of deflation to come on asset prices worldwide. That was for me, the theme of the weekend was deflation, beginning of deflationary worries into that key inflation report.
Quite a ride in the bond market last week, TK. This morning, yields higher again by 7 basis points, taking back some of the move from Friday's session. Tom, lots of Fed speak out there in the mix as well. Over the weekend, Governor Bauman teeing up maybe another interest rate hike at the Federal Reserve.
If Fed speaks just what it is, it's going to go by the data. The jobs report, I'm not sure. What do you think? Cut this way, cut that way kind of jobs report?
Bit of tension, Tom. I think a bit of tension between the headline number, deceleration, wages still pretty hot. A belief, I think, still the narrative sticks. And Jeff Rosenberg of BlackRock talked about it, Lisa, that ultimately where payrolls growth goes, wages will eventually follow. The Fed sits there and says, we hope.
That's basically where we're at when you talk about Michelle Bowman. On the other hand, John Williams had an interview with Gina Smilek over at the New York Times, basically saying that potentially they could cut rates as soon as early of next year. So you have all of the polls coming out with conflicting data, leaving a lot of people on Wall Street just basically saying, we'll do what we want to do, and we'll trade the way we want to trade, and that means yields incrementally higher.
I agree. It's got that summer goofiness to it, if you will, and we'll see it in bonds and equities. We'll monitor through the day. But going to this inflation report, which is clearly the key data this week, internationally, there are these deflation tinges there. The FT with a private equity story. They're giving haircuts now on private equity. I'm sorry, that's a form of non-Fed, non-Bank of England deflation.
Kashkari did a pretty good job at the start of the year to set up the year ahead. He said the first phase of policy is to get interest rates up quickly. The second phase is to sit there and hold there for a while. I think we're in between two phases right now on the committee. You've got some officials still discussing going higher. Some officials, including Goolsby, going into the weekend discussing maybe the second phase. Let's have that conversation now. Let's talk about how long.
Right.
Is it how high still, or is it shifted to how long? That's where we are at the moment, in between those two phases on the committee.
And to Jackson Hole, the aerospace engineer Kashkari's on the x-axis, and he understands the importance of time affecting all these things we talk about. And if you extend out time, keep interest rates where they are, different things can happen.
Let's get to the price section this Monday morning. Good morning to you all. Your equity market slightly positive on the S&P 500. A lift here by 0.4%. A lift in the bond market too for yields. Treasuries down, yields up by 7 or 8 basis points on a 10-year, 4.1%. Bit of euro weakness out there, Lisa. 109.68 on the euro against the dollar.
And that's been a trend, this feeling that maybe Europe won't do as well relative to the U.S. As people had previously thought this year. 8:30 a.m., it sets up the Fed speak beautifully because it has both poles of the Federal Reserve coming together at 8:30. Raphael Bostic of the Atlanta Fed, Fed Governor Michelle Bowman, both speaking. Raphael Bostic has been more dovish. Michelle Bowman has been more hawkish. I would love to have them have it out. I don't think it's that kind of event, but let's see. Today, a relatively quiet earnings week. Only 33 companies are reporting of the S&P. Today's reports include Tyson around 7 a.m. You also have Palantir Technologies, Paramount, and Beyond Meat. What I find interesting, look at Palantir's shares. They're up 183% year to date. Tyson Foods, the chicken manufacturer, down 9.3%. Beyond Meat up 28%. This is a market of stocks. We try to come up with headline ideas, but this is a market of divergent stories that have very different fates.
Beyond Meat, is it like the old AI? You remember when Beyond Meat was everything?
Oh, you're trying to come up with a broad theme.
We've gone from 220 to 15 on Beyond Meat. I mean,
you said it's the new AI.
No, it's part of the AI uproar, like Beyond Meat.
You long vegans. Is that what that chart's about?
I just, I remember when Beyond Meat was out. When Beyond Meat was like the rage. I was like, are you kidding me? Have you ever eaten it?
I have not. It's actually supposed to not be as healthy as regular meat.
Very salty.
Yeah.
I had one before.
You liked it?
I had one.
It tasted like there's a lot of sodium in that stuff. I've had some.
We can move on to talk about that later, but just want to mention this. Lastly, at 3 p.m., we get the U.S. consumer credit for the month of June. And this will be interesting because we've seen this bifurcation, auto loans coming down, mortgages coming down, credit card outstanding debt increasing at a slower pace last month, but do we see that reaccelerate, and how long can consumers continue to really keep spending unless they keep borrowing?
Let's start the conversation this morning with Laurie Calvasina, head of U.S. equity strategy at RBC Capital Markets. Laurie, the headline in your most recent piece, due for a pause. Due for a pause. What does that mean, Laurie?
So, look, I don't want anyone to come away from this thinking that Laurie Calvasina is turning super bearish, but we don't like where we are, sort of in the intermediate term. And we're seeing a couple things. We went, every few months, right, we make sure we publish an update on our targets, our price target for the S&P. A couple of my cross-asset models are deteriorating. They were improving back in May. So in other words, the appeal of stocks relative to bonds is worsening. And also our sentiment model is really bothering us. It's really back at one standard deviation above its long-term average. If you look at net bullishness on the AAII survey, typically you see, kind of mid to low single-digit gains in the S&P over the next 12 months when that happens. And this just feels to me like a market, while I think everything has been deserved in terms of what we've done so far, it just feels like this market needs to stop, pause, have a little moment of digestion, and catch its breath.
Okay, I like the analysis, and the idea is you got to pull back to get the, get the fear clicking, and we've all done this and studied it. Can you just state flat out we're through with the bear market?
I never really subscribed to that thesis to begin with Tom. I never liked this whole concept of we're in a bear market, therefore we have to do X. We're having a bear market rally. It's false. Don't believe it. I just was never in that camp. I think we priced in a recession last October, and we've basically been having a plain old-fashioned recovery trade. And now we're seeing some of the things that were really telling us to hold your nose and buy at the beginning of the year. I go back to that sentiment model, is telling us we need to calm down for a little while.
Ben Laidler over at eToro writes up on the Lord Calvasina world this morning. He talks about value, talks about what's out there away from 7 chosen stocks as well. Color or shape the value of mid caps right now?
So it's interesting, Tom. We do a lot of work on small caps, but we've also been getting increasing questions on mid caps. In our big chart deck we published this morning, we actually added a mid cap section for the first time in quite some time. And it's a pretty similar story to small caps. They tend to benefit when you're in recovery mode. They've started to do that a little bit, but not as much as we would have expected. The valuation story is pretty reasonable. If you look at the multiples versus history, the mid caps look very cheap versus the mega caps right now. And if we get a recovery in 2024, there should be more upside there. So we do feel like, similar to how we feel in small caps, we feel like that mid cap part of the market where large cap managers actually can gravitate down to, we feel like that's ripe for a catch-up trade as well.
Lori, we're going to be speaking with Mike Wilson of Morgan Stanley later in this morning, which I'm really looking forward to. He has a note out talking about the fiscal backdrop and how much of a variable that is with respect to stock performance. How does that factor into what you're expecting going into an election year, which tends to be tumultuous?
So, when we were going through this targeting, kind of refresh last week, so we looked at one of our political tests, which is just a simple election cycle test. And one of the things we noticed is that the current year that we're in tends to be one of the strongest for the markets. So it's been, kind of one of the more positive signals. And next year, the election year itself, or a presidential year, tends to be one of the weaker years in the election cycle. And I just juxtapose that with what I've been hearing from investors. They keep asking me, well, when are people going to start paying attention to the election? There are a lot of questions that are starting to come up. And my response to the investors I'm speaking with is, I think it's starting now, because you're all asking me about it. And it seems to me that this is emerging as just a very, very big source of uncertainty as to what is going to happen with the election next year, both in terms of the presidential race and Congress.
So then what is the election cycle playbook? What is how you play this particular type of uncertainty versus the uncertainty of where we are in the inflation cycle and the Federal Reserve?
Well, I think there's a lot of, questions that are starting to emerge about the outcome. One of the things I'm hearing from investors are, they're trying to probe whether or not there are alternatives to Biden. I'm hearing a lot of questions about that from international investors in particular. I think there's a lot of head scratching over what's going on the Republican side, especially with DeSantis. There was some excitement there early on. Now that seems to have faded a bit. But I think this is just really an air pocket of uncertainty that's starting to emerge. We're not even really having detailed conversation with clients yet about what either side would want to do, policy measures. It's really, I think just frankly, this overhang of not knowing what the outcome is going to be that could push investors to the sidelines for a little bit. And I think that's going to weigh heavily once we get to the fourth quarter, when everyone starts putting their outlook discussions out, right? They're going to be talking about Fed cuts in the back half of the year, but they're also going to be talking about the election. So we kind of see those things starting to come into the conversation.
We have more outlooks to come? Oh, joy.
Well, some of those outlooks are being revised pretty quickly. The recession calls on Wall Street dropping like flies, TK. Mike Gapin in the last week, Mike Ferroli, JP Morgan going into the weekend, dropping his recession call too.
Can you see Calvasina on the deck with a fam, working on her outlook, gin and tonic on the table next to her?
In the summer?
Getting through the August.
The mid-year outlook?
The summer, the mid-year.
The mid-year outlook. The summertime.
The summer adjustment.
The summertime outlook. Laurie, can I finish on a single name? Forgive me. What does it say about the market when the biggest weighting on the S&P 500 has had 3 quarters of declining sales, trades at 30 times earnings, and is up 40% year to date? What can you take away from that? What's the signal you take from that?
One of the reasons why I think people have been gravitating towards these mega cap growth stocks is that we are in recovery mode, and the shape of that recovery doesn't look so fantastic. I think the price we're going to pay for a short, shallow, or skipped recession is subpar economic growth for a few years. And if you look at consensus forecasts as tracked by Bloomberg, basically for next year and 2025, GDP is expected to be in kind of that 0 to 2% range. Well, guess what? Growth stocks typically do well when economic growth is scarce, and I think that's one of the reasons why people have been just plowing so much money into these big mega cap names, because despite some of the near-term challenges, they have faith that the longer-term growth opportunities are still there.
Laurie, thank you. Laurie Calvasina of RBC on some of the tech stories so far this year. TK, can you still call Apple a growth stock when there is no growth?
We don't have the length of the show to answer that question.
It can be a theme for the week ahead.
Well, I mean, they did terrible. They just their earnings were just terrible.
Biggest one-day loss of the year on Friday.
Generation?
Okay.
I don't have the numbers in front of me. They did like 26 gajillion, and they spent 23 gajillion sending it back to shareholders.
This is your world. Are you describing a value stock or a growth stock?
I think it's both. Is to be honest, it's both, and that's the attraction of some of these companies. What I would say is it's growth, and this is the key thing, and this is the CFA wonkiness, is where do you set your terminal value? The stocks that Lori Calvasina is looking at have a 3-year, 5-year study. How can you do a 3-year study on Apple? It's got to be 7 years, 8 years. Apple for 10 years, and other names as well. I'm not saying buy Apple.
My favorite part of the analysis with Apple had to do with their cash pile generating cash.
Exactly.
Because we actually have interest rates now, and how that actually is a net positive to their bottom line and top line all around, because they're earning 5% or whatever on, the size of cash. What is it? The size of the Swiss economy or something? I mean, it's massive. And so you start looking at this kind of thing.
There's a bar chart on Twitter this morning, there's a bar chart on X this morning, which shows Apple services and the revenues of like Spotify, MasterCard, and the rest, just the services part. We equate Spotify with Apple, which is garbage. That is
I'm
real
just
big
asking
mistake.
questions. Look, I can earn 5% cash. Do I want to give that cash to a company that's trading at 30 times earnings? That's the question I think a lot of people have got to ask themselves. They were asking it on Friday. You mentioned the platform formerly known as Twitter. Elon Musk over the weekend said the Zuck versus Musk fight will be live streamed on X. All proceeds will go to charity for veterans. Yeah. Mark Zuckerberg, do you see what he wrote back on Threads?
No,
Shouldn't we use a more reliable platform that can actually raise money for charity?
Well, and then you heard Elon Musk say he might need surgery.
I mean, come on. This is just ridiculous. The whole thing's ridiculous. Mike Wilson, not ridiculous. That conversation in a couple of hours' time.
Wilson is just as cut.
You think he wants a cage fight?
Yeah, he is.
Wants a cage fight. Who wins?
He's like,
We have to find some equity bull, Tom. John Stelfus, Mike Wilson.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And the Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The American people deserve to know that President Trump, asked me to put him over my oath to the Constitution, but I kept my oath and I always will. And I'm running for president in part because I think anyone who puts themselves over the Constitution should never be president of the United States. I have no plans to testify, but look, we'll always comply with the law. But look, I want to tell you, I don't know what the path of this indictment will be,
That was Mike Pence, the former vice president and 2024 presidential candidate, speaking to CNN over the weekend. Live from New York City this morning. Good morning to you all as we kick off a brand new trading week. Your equity market on the S&P 500 shaping up as follows: positive by 0.3% on a 4-day losing streak and following the biggest one-week loss going all the way back to March on the S&P. Responsible for some of that volatility, that risk aversion, it was in the bond market. Yields up and away Monday through Thursday. They came back down on Friday, and now they spike higher again this morning by 8 basis points on a 10-year TK, 411.48. This from Anna Wong of Bloomberg Economics. As everyone starts dropping their recession calls, from the Fed staff to Mike Ferroli to Mike Gapin of JP Morgan and Bank of America respectfully. Take a listen to this. If the recession we predict this year is delayed rather than averted, and the Fed ultimately has to hike more than we currently anticipate, Anna Wong and the team finish with this line: the most likely culprit will be Bidenomics. That's the take from Bloomberg Economics, TK, this morning.
Let's remind ourselves, she has been absolutely dead on. When Anna Wong writes, you have to read it. And the answer here is, I need you to help me with what Bidenomics is, other than various forms of stimulus. And, as I mentioned, the deflationary tone I'm looking at through August, part of that is quote-unquote fiscal tightening, which is out in the zeitgeist as well this morning.
Is that fiscal tightening in the zeitgeist right now, or is it on the horizon into next year?
On the horizon, yeah.
I would argue that maybe some people would say that it's not on the horizon, which is part of the reason why they might see the Fed having to come in and do something more, which is the reason why we heard that from Mike Wilson.
And it would speak to the Treasury supply that we had in the last week, Tom, and the indication there is a lot more to come.
What I would look at is there a road in Manhattan that's not being ripped up to be repaved?
Is there a road in Manhattan that shouldn't be ripped up and repaved?
For those of you that don't know this, the streets of New York are like you're driving on a country road and name your third world country.
I was walking through Soho. They're doing the same street that they've been doing for 3 years. 3 years. I almost stopped and asked them at the weekend.
My favorite is when you go to any other place, it says bump ahead of like whatever, and there's a little bump. They just have a big sign in New York City that says bump ahead.
Boom, 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 boom. I have a turn just like that. There's a turn I do on Park Avenue. They've been working on that turn literally for 3 years.
What's
without
going
exaggeration.
On? Ask Greg Valliere.
There's your fiscal report for this morning from Manhattan. We welcome all of you across this nation to California and worldwide as well. Joining us, yeoman's duty from California this morning, Gregory Valliere, Chief U.S. Policy Strategist at AGF Investments. There it was at the White House Correspondents' Dinner, Greg. Tammy Haddad was throwing her party, and off to the side was the governor of California, smooth, elegant, doing his Hollywood finesse. He's supposed to have a debate with the governor of Florida, who even his supporters say is not smooth and not finesse. What would a Newsom-DeSantis debate look like, and should we care?
I think it might be stopped in a TKO fairly early. Newsom is awfully slick. He's the ultimate smooth politician, best hair in politics, and I think he'd have a pretty easy time. I mean, the dissent by DeSantis continues with things that he has said. He's upset Floridians by not taking on insurance companies in Florida. I think the issue is soon going to be who's second. I'm not sure it's going to be DeSantis for much longer.
I understand that an incumbent president always has priority, but the people like the governor of California, are they lined up in waiting, including the vice president, I should say?
I think, Tom, that Gavin Newsom is itching to run. He's got some baggage, like all politicians. He's maybe too far to the left for the American public to embrace, but he's really good. He's very articulate. He's charismatic, and I do think he's going to be a big player. It's still too early to say Joe Biden is not going to run, but I just don't sense any enthusiasm when I travel around the country for a second Joe Biden term. Bidenomics has become a negative almost. It's like Edsel or malaise. I mean, there are certain words that you don't want to have attached to you, and Bidenomics is not helping Joe Biden.
Greg, the percentage of people watching and listening that know what Edsel is, I mean, we're down minuscule. Lisa, pick it up. That was a car from a few years ago.
Thank you, Tom.
Fair point.
There is a question as you talk about Bidenomics, how we pivot in a new era. Is it going to be fiscal restraint? Is it going to be fiscal expenditures that just prolong a cycle, perhaps at the expense of higher inflation?
Well, I think the American voters are still spooked out by inflation, and Bidenomics is not helping at all. I would argue that the big story domestically this fall is going to be increasing fiscal austerity. Kevin McCarthy's got to come up with a real trick to get the House to vote for a tight budget, even on defense. And I do think that the American voters associate spending with inflation.
Meanwhile, we have this story on the Bloomberg this morning about the potential for another government shutdown, with the Fitch rating downgrade really emboldening people who are more on the fiscal hawk side to really push for some of those spending cuts. Do you anticipate that type of drama heading into the end of the year?
Yeah, I do, Lisa. I think Fitch has two big problems. One is that we're dysfunctional in Washington on spending. Well, that's not going to get any better. It might get worse. The second big problem is that we're politically unstable. That's not going to get better. That could get worse. So on the two key issues that upsets Fitch, things don't look good at all.
Given that, how much do bond vigilantes scare the bejesus out of people in Washington, D.C. right now when they take a look at the idea that their interest expenses are climbing rapidly and people are actually truly pushing back in a way that they haven't for years?
Well, you would think that this would start to really affect Washington, but I think the bond vigilantes and concern on rates is not going to lead to any big policy change anytime soon. We've got to wait until mid-September. Then things are going to get very, very active. And I do think a government shutdown either on October 1 or in December is a better than 50% chance.
I'm asking the same question at the moment with regards to the debate later on this month, Greg. Any updates there? Is the former president attending or not?
I think he has to. I mean, he loves the limelight. I'd be surprised if he didn't. People would say he's chicken. But again, this is just a fight for number two, maybe a fight for the vice presidential nomination. I mean, Trump has got a close to a 40-point lead on all the other Republicans. It's awfully hard to see that lead evaporate.
Greg, good to start the week with you. And good morning to you, Greg. Thank you, sir. Greg Valliere of AGF Investments. Is that debate confirmed, Tom? Newsom, DeSantis. Is that happening?
No, the way I read it, it's not. Correct me if I'm wrong, but maybe the desk here knows that. But I believe it is not confirmed as well.
Okay.
Our desk has not informed me.
Interesting.
I went to them this morning.
What would the value be in that for Governor DeSantis? Why would he want to engage with the governor of California when he's got a presidential race?
His core audience. He wants to. Gavin Newsom, to translate this, folks, Gavin Newsom represents woke. All that the governor of Florida has is a philosophy on woke. So if he debates woke, take it from there.
It was reported last week that Governor DeSantis, I believe on Thursday, did agree to a longstanding offer by Governor Newsom to debate. And I think I think you highlight the right point, especially education, especially some of the other policies. Ron DeSantis wants to come out as firmly opposed to all of that, and that might be a good talking point for him. And Governor Newsom sees it as a way to really expand on the global stage.
My only thing is to agree with Mr. Valliere. I mean, the hair at the White House dinner when I saw Governor Newsom, the hair was.
You're impressed by that, were you?
The hair just, the hair just.
Did you ever catch the interview between Sean Hannity of Fox News and Governor Newsom?
No.
Hannity's a tough interviewer, and Newsom did a pretty decent job.
Yeah.
Pretty decent job. So if I was Governor DeSantis, I'd go over that and have a look at some of what those talking points might have been and how he responded to them. Coming up shortly, Vasily Serebryakov of UBS on what's developing in this market at the moment. It's been a big move in the past week or so. Bonds down, yields up for Treasuries Monday, Tuesday, Wednesday, Thursday. Then on Friday, just snapped back. Yields aggressively lower following the jobs report on Friday. Looking at the bond market this morning, up 8 basis points on a 10-year to 4.11. You can call it 4.12. On a 2-year, up 8 basis points to about 4.85. And in the equity market, trying to bounce back from a 4-day losing streak on the S&P 500. Apple trying to do the same. Biggest one-day drop on Friday of the year so far. Equity futures up 0.25% from New York. Good morning.
what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
It's a slow start to the week. It should pick up towards the back end with inflation data on Thursday, CPI, then PPI data on Friday. Going into all of that, your equity market with a little bit of a lift on the S&P 500 up by 0.2%. Coming off the back of a 4-day losing streak, that daily losing streak, the longest going back to something like May. In the NASDAQ, positive by 1/3% this morning. Both the S&P and the NASDAQ experiencing their worst week since March last week. In the bond market, 2-year, 10-year, 30-year yield higher this morning by 8 basis points at the front end, 4.85 on a 10-year by 8 basis points. So let's call it about 4.11, 4.12. Tom, all over the place last week. Yields higher, and aggressively lower in Friday's session, and we snapped back once again this morning.
About a reset, you look at the spread market. We had the headline out moments ago on Germany. The 30-year bond in Germany has a yield back to 2000, I believe, 14, and you know, the answer is we're migrating back there. You go out 10 years, you go out 20 years, and we're literally repricing. My criticism is we look at yield. I look at price. What it means is price down.
Price down.
That's a hard.
Let's migrate from bonds to foreign exchange just quickly. In FX right now, in G10, the dollar stronger against absolutely everything, including against the euro. It's a break of 110 once again over the last few days. 109.71. We're negative here, Lisa, by let's call it 0.3% on that currency pair.
This comes as a lot of people talk about possibly the end of the rate hiking cycle, both in the U.S. and Europe. Surprisingly, in Europe, when every single person you talked to in London earlier this year, every single person said the ECB was going to go further than the Fed in 2023. Okay, what now? How do you rearrange all of those wagers on the heels of something that looks very different from that?
And European growth has disappointed in a huge way, and the upside surprises have come from, guess where? Not Europe, from the United States. Under surveillance this morning, plenty of Fed speak through the week going into CPI on Thursday. Governor Bowman speaking over the weekend indicating, quote, here is the quote, additional rate increases will likely be needed to get inflation on a path down to the FOMC's 2% target. There is a range of views, Tom, on the FOMC. That is one. Others believe maybe we're done here and we should talk about the length of time spent at 5.5% interest rates at the Federal Reserve, Goolsby being one of them. And I think Bostic indicating also, speaking to David Weston going into the weekend, Tom, that ultimately that period of time, once we get to that peak rate, will be a long time. We'll be sitting there for a while waiting for inflation to come back down.
I'm going to go back to the heritage, John, of what we did with Bloomberg surveillance. Who's giving you the message? Who are these people? Where do they come from? What's their pedigree, et cetera? Goolsby is the real deal. Thank you, Milton Academy, for the note out on Twitter. He came out as superb academics at Milton Academy, bulletproof PhD economics, over to Chicago, arguably our best microeconomic foundation, on and on. Bostic, the same way. Bowman was an intern for Bob Dole. And she's a George Bush acolyte. She's an attorney. That statement she did is, you know, it's boilerplate. It could be written by any number of PhDs there. But you got to know who's talking to who. Bostic, you really lean forward and listen to.
She's got a vote on the committee, doesn't she? It's worth listening to. Not alone, I don't think, either, Tom. Based on the projections of the FOMC, some people think there might be more than one.
There's no question about that the view is there. No question about
Lisa, you got things to say?
I've got lots of things to say. I'll just say this. A lot of people with PhDs in economics have gotten it wrong also. Nobody's gotten it right. That's all I'll say.
Okay. Tell us what you really think, TK. Elsewhere, Israeli Prime Minister Benjamin Netanyahu speaking to Bloomberg, saying he won't pursue the entire judicial overhaul originally planned by his government.
I hope that we don't get into a constitutional crisis. I think we won't. I think there's a way of reaching an equitable compromise, which is what I'm trying to do.
Netanyahu said his government was now working only to change the makeup of the judge selection committee. Elisa, you wonder how much some of the market turmoil in more recent weeks had to do with, can we call this backtracking? It feels like backtracking to me.
He also said, we want smart money. We want all of your money invested in Israel. It's good. What's interesting to me is he's not doing a media tour in Israeli media. He's doing a media tour in international media. And this is something not lost on the many Israeli journalists. There is a question, yes, is he backtracking? Yes, is he trying to make Israel sound more amenable to money coming in at a time of incredible political friction, even if he just isolated this to this change?
To me, and I'm speaking completely outside my remit here, the fact is he's 73, which is sort of pretty younger. But at the same time, is this a generational divide in Israel where he represents the people that he respected, Ariel Sharon and the others, and there's a younger generation of Israel that's just walking away from the dialogue.
Great exchange with Francine Lacroix over the weekend. You can find the full exchange on Bloomberg.com and on the Bloomberg terminal. I suggest you take a look at the longer extended interview of that. I want to turn to this from HSBC's head of public affairs. Sherrod Kalpakol saying this. He's said to have told attendants at a closed-door event in London back in June that the UK would often bow to the demand of Washington. He accused the British government of being weak when it comes to China. Kalpakol said in a statement to Bloomberg that his personal comments did not reflect the views of HSBC. Lisa, maybe a little bit ironic to come from HSBC, which, when it comes to China, might be accused of being weak itself on certain issues in foreign relations.
When I was reading the story yesterday, I was thinking to myself, this is going to fly very poorly because it just edifies this feeling that HSBC ignores the status quo of the Western world and tries to go off and lure business from China. It comes at the same time over the weekend. Did you read about this? That Chinese authorities are pressuring top economists to not be too negative on their economic outlooks for China. So it raises a lot of questions about some of the outlooks and things of that nature.
Story as old as time, that is.
Yeah, I mean, but this is yeah, but it comes out at a time of some serious concern. So, you know, you just start to think about alliance. It's interesting.
When you grew up in England, was HSBC a British bank, or were they those Asian guys that were in Britain? I mean, what was that image?
No, I think we considered that a British bank.
It was a British bank.
Yeah.
Yeah.
Yeah, of course.
To me, I always feel incredibly foreign debating about it. You know, in Hong Kong and Shanghai and the rest. I mean, I don't know where they fit in right now.
I just think it's interesting because this is an increasing debate. Does the rest of the world go along with the U.S.? How clean are these fissures between, you know, China versus the U.S. and who has to align with who? And you've seen that with Emmanuel Macron.
In a perfect world, multinationals sit on the fence.
Yep.
Can they sit on the fence anymore?
Politically, maybe they can or maybe they're not, but I would say it's hugely dynamic right now. Witness the import dynamics of China, where Mexico is becoming far more dominant, only because China is becoming less so. Right now, on foreign exchange, Vasily Starvikov joins us now, macro strategist and on foreign exchange at UBS as well. Vasily, what we see is a strong dollar, but I really don't see it on a blended index. I see a stable dollar. Is it a stronger dollar forward or a stable dollar forward?
Well, we think it's actually a weaker dollar forward from here. I think the FX market is in kind of a tough spot at the moment in the sense that it's difficult to really navigate a lot of these cross currents. As you were saying previously on the program, you know, it seems like the U.S. economy is outperforming, but at the same time, it seems like we're getting to the end of the Fed tightening cycle. So which way do we go? In our view, the end of the tightening cycle actually dominates, and that's what you've seen in the past 6 Fed cycles. Whenever the Fed stops hiking and starts transitioning to a pause and then eventually rate cuts, the dollar tends to weaken, and usually because front-end yields in the U.S. fall. It has been somewhat of a messy transition, I would say, and it's still uncertain and very much data dependent. But I think that's kind of where we're going ultimately.
To a stronger euro 115 or a far more stronger yen, and folks, over the weekend, the Economist redid the Big Mac index to show how absolutely unique the Japanese yen is. Do you look at those moves as leading to instability or less so?
I don't think this is, leading to any particular instability, but it is largely a function of, I think, what happens to U.S. monetary policy rather than happens to the rest of the world. So I think that the argument here is not that Europe or China are going to reaccelerate particularly. I think the argument here is that U.S. monetary policy is turning more and more restrictive, as I think Chair Powell pointed out in the last press conference, right, with inflation coming down. And we think we're going to see more evidence of that this week. Real rates are getting more and more restrictive. And ultimately, that means that the growth numbers are going to follow as well. And that's when the Fed starts to pivot. Now, I think the difficulty and sort of where the upside risk for the dollar is really risk sentiment, right? And we've seen that past week when S&P didn't have a great week on the back of high yields on the long end. But ultimately, if the Fed has the ability to start pivoting towards the end of the year, that's the dominant driver for the FX market, and that probably outweighs any sort of wobbles in equities that we might see.
Vasily, you said that typically the dollar weakens when the Fed pauses or reaches the end of their tightening cycle. But what happens if everybody else also is reaching the end of their rate hiking cycle at the same time? In other words, who does the dollar weaken against if Europe also might be reaching the end of the rate hiking cycle?
Yeah, no, I think that's kind of a great question, and that's probably where a lot of sort of divided opinion is in the FX market at the moment. Generally, what we've seen is the Fed tends to dominate all other central banks in terms of the driver when it pivots, just because of the importance of sort of U.S. rates. It is also true that compared to, say, the ECB, the Fed has a dual mandate. And I think the argument here is that if inflation is under control, which is still a big if, but we're going to see next week, and then before the September FOMC meeting, there's another CPI report. But if inflation is under control, then the Fed sort of has more room to react to any growth weakness. And in fact, is going to be faster at doing that than the ECB, which is much more just squarely focused on inflation, wages, and inflation projections. So in that sense, at some point, the dual mandate sort of kicks in vis-a-vis some of those other central banks that are more squarely, so to speak, focused on inflation.
How much would potential dollar weakening stem also from what we saw out of Fitch last week and this fear around ongoing incurrence of debt, even at a time where the unemployment rate is so low in the U.S.?
Yeah, that's actually been kind of a tough way to trade the dollar, and even going back to 2011, right, when S&P downgraded the U.S., we saw some strength in the Japanese yen, but the dollar actually did fairly well at the time. So that's a harder read, I think, mainly because the long end of the curve is less important for currencies anyway. And as we've said, equities might react negatively. It tends to give the dollar a bit of a safe haven bid. So it sort of works in the background. Yes, I think if you ever get into a weaker dollar environment, then those additional drivers or forces tend to kind of add to the dollar weakness, but we're not there at this point. So certainly, if you're looking at the Fitch move last week, I wouldn't use that as a reason to sell the dollar.
I'm not sure how many people are, to be honest. Vasily Serebryakov of UPS. So many people pushing back against that being a catalyst for absolutely anything. To Lisa's point, you've got the ECB talking about maybe being done. There are some thoughts that perhaps the Bank of England is closer to that point, but that's going to remain to be seen based on the incoming information on the CPI front. The Federal Reserve, maybe there's 25, 50, there's a feeling they're almost done. Lisa, the rest of the world, emerging markets have started cutting. Chile, Brazil, there's a feeling that others follow too later in 2023.
And then here's the question. Brazil's cutting to what? 13.75%. I mean,
Sure.
Coming down significantly to something that's also still significant. But you raise a great point. At what point does the carry trade not work anymore? Do some of these higher yielding currencies hold less luster and kind of really drive a shift back to developing market? It's such an interesting moment, right, where you're not seeing people go into those currencies as a result of this.
Where we are now versus, say, the third week of December last year, Do we have any greater clarity than we did then? I don't think we do. We're farther on from the pandemic. I'll give them that. We're farther on from a medical disaster. I guess there's some things we can believe in, like Barbie. But the bottom line is, why do we have certitude now about the view to Q4 or Q1 of next year? I just don't know where that comes from.
I don't think we do. Veronica Clark of Citi's going to join us later, Tom.
Yeah.
And a team at Citi are anticipating that inflation starts to pick up again, going into the turn of the year and going into early 2024. That conversation worth a look. That coming up very shortly. Veronica Clark over at Citigroup, Tom. Looking forward to that conversation.
It's going to be interesting to see. And let's remember, we've got to keep score about who actually got this right, and that gives us some faith in their belief forward. Anna Wong at Bloomberg, what Hollenhorst and the team did at Citigroup. But I just think a large dose of humility is in order now as we try to get children to begin their summer reading.
I thought you were about to call economists on Wall Street children. We tried to get children to drop their recession calls.
It's a time of year.
My child to drop his
It's
recession
the time, at least it's the time of year where it's the pile's there. Let's begin.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City.
From London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
It's a job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the lower unemployment rate. The marketplace favors at the margin the softer landing interpretation as of now.
The brilliant Mohammed Al-Erin of Queen's College, Cambridge on Friday. Bottom line, there's always something to worry about, and there was plenty to worry about based on whatever you thought on all the economic data going into Friday. That's how Bramo feels about most of the incoming information. CPI later this week on Thursday, PPI on Friday, more inflationary reads in America at the back end of this week. Going into all of that, your equity market on the S&P 500, positive by 0.2%. Tom trying to bounce back from a 4-day losing streak on the S&P 500.
Bounce back. Do we think earnings here matter this week? I don't hear it. I mean, there's, like you mentioned, Lisa, earlier, there's some earnings reports out there, but we're sort of beyond that, right?
And then the second that you say that, there's going to be that one earnings report that crystallizes the fear in markets and unravels everything. So keep saying that.
The company no one cares about.
Exactly, that's exactly it.
Did you see what they said?
Palantir, artificial intelligence, it's never going to happen.
What do they do?
Exactly.
I've never heard of that company.
And then we're going to be talking about that for the next 3 weeks.
I mean, I'm looking at a
Yellow's gone bankrupt.
Well, that's a big deal.
I'm with you. It's a big deal for 30,000 people that have lost their job, Tom. Does that give you a macro signal on the broader economy when the likes of Gapin's dropping their recession call? Rhodey's done the same thing. The Fed staff are doing the same thing.
Yellow's sort of like, the Port of LA, Port of Long Beach and all that. It has to do with the logistics of the nation. And to me, it's more than 30,000 people. It's moving stuff around.
Especially because FedEx pilots are now looking organized.
I'm looking at Standard Poor's. I'm going to throw this up on TV because Good Morning to Radio worldwide. And the answer, John, is we're mid-trend on Standard & Poor's 500. We've gone from +2 standard deviation. I can give you the exact date on that, July 27. In over a week and a half, we've come right back down, smack dab on my long-term moving average. The damage, as Calvacina mentioned earlier, this pullback is completely normal. And, we're trying to make some theater out of it. I don't see any theater on the screen.
Not trying to make theatre out of anything. We've had massive year-to-date gains.
Yeah.
Tom, I brought up Apple, and for good reason. It's the biggest weighting on the S&P 500. It's had 3 quarters of negative sales growth, Tom. And Lisa, I would say if you're experiencing 3 quarters of softer sales growth, yet your stock is still up by 40% year-to-date, and you're trading at a multiple of 30 times earnings, got to ask some questions, haven't we?
If you've got earnings that are actually the weakest, declining, the most going back to 2020 at the peak of the pandemic, on average, when you gloss over some of the others, you have to wonder. I have to say, Tom, you think that we're gloomy and doomy? I could go full gloom. This is not full gloom in any way, shape, or form.
We know you need no encouragement.
Veronica will walk out of the room.
I'll just say, this is not extra drama. I will just say.
Well, please, full gloom. Give us a tinge of
it's
full
great.
gloom.
Let's move on.
Okay.
You're getting to our guest.
I'm just waiting for the full gloom. Veronica Clark's going, what did I walk into? Economist at Citigroup, and they have not been full gloom. They've been looking for a higher interest rate regime and the idea that America will prosper throughout it. Let's go there. You guys, taking a victory lap for the last 6 months, you've really been right about the resiliency of the American economy with high rates. Do you just assume within the Citigroup view that if we do have a new rate regime, a higher reset back before 2007, 2006, that we'll be fine?
I don't know. I think we actually might be relatively gloomy now compared to some other people.
You can be full gloom if you'd like.
We're not full gloom, I would say. But yeah, we're not terribly optimistic that we will get this true soft landing. It might look that way for a couple months in the data. We'll obviously get CPI this week, and that will look softer again. We had a very still strong jobs report on Friday. But I think we're really less optimistic that this will end well, and that inflation will come back sustainably to 2% without some bigger downturn. It just depends on when we get that. We still think maybe first half of next year. But yeah, the next 6 months could look pretty good.
So to be clear here, you're calling for a recession still, as this is a weekend where other people are pulling back from that?
Yeah, basically just the assumption that if we are getting inflation sustainably back to 2%, that has to happen with some kind of contraction, something that we would call a recession.
How much does your call really hinge on the fiscal impulse? How much Bidenomics continues to pump cash into the economy versus some sort of fiscal restraint, sort of boogeyman out there that some people talk about?
Yeah, we could be seeing some of that. I think in some of the data we've seen this year. Obviously, we've had construction investment in manufacturing structures, building new facilities. That might be related to policies. It's just the general onshoring, reshoring after pandemic disruptions of the last couple of years. I think we'd be skeptical that that will last too much longer. I think one thing that we learned from the debt ceiling debacle is that there's really not a ton of appetite for additional fiscal spending. It could be hard, especially as we're getting into an election year next year. So I don't know if that's a long-lasting trend.
That said, it doesn't seem like there's a lot of appetite to make material cuts right now. Going forward, how much does that underpin a call for higher yields, at least at the longer end of the yield curve over a longer period of time, given the potential for increased deficits and inflation that's not going to come down so much?
Yeah, I think that's obviously a huge part of the move that we saw in longer end yields last week. And yeah, there's not necessarily the appetite for additional fiscal spending, but I agree that even traditionally more fiscal conservatives are less inclined towards cuts. And that is definitely a factor of keeping yields higher for longer.
Can we get a little bit deeper? Can you explain to everybody where you're seeing that fiscal stimulus lift the economy? What was it? Where's it working?
Yeah, it's always really hard to know exactly what we're seeing in GDP data, where it's coming from, but we definitely have seen investment in manufacturing structures picking up over the last couple quarters. Maybe that's related to infrastructure, CHIPS Act. You're seeing it some in public investment, the infrastructure spending that's now coming out. But all of that, of course, is already legislated, and now we're starting to see that in the data maybe. But it's always really hard to know exactly how much we can attribute.
Do you get a sense that's based on spending, or is that just based on a shift in policy? The crowding in and getting people to spend here
it's
home?
both. I'm sure some of it is direct, and some of it is also probably incentives for people for reshoring, onshoring, and some of that probably would have happened even without government.
How much from what we got on Friday, the idea of a jobs number that could give you any story that you wanted, as we look ahead to CPI, how much are people looking at it or just shrugging it off as a potential head fake, an inflation smile, as Mohammed Al-Arian calls it?
Yeah, there really was something for everyone. I think the most interesting part of the jobs data that we've seen the last couple months is that we are getting this interesting pickup in wages again. We've had a couple months where average hourly earnings are printing 5% annualized, and that's definitely stronger than they had been printing for earlier in this year. Other measures like the Atlanta Fed wage tracker, that'll come out later this week, running from 5 to 6%. So you are still having a really tight labor market, and you can see job growth, headline job figures slowing just as you are running out of people to hire even. So a combination of lower unemployment rate, strong wage growth, softer than expected jobs kind of looks like that supply issue again.
Too quickly here, but we'll, I'm sure, talk about it in the coming weeks. For the next 6 weeks, 8 weeks, my clear number one data point is the 10-year real yield. And the answer is we've gone from a 1.50 up to 1.70, even 1.80. The history pre-crisis, pre-06, is about 2.05. Where do you and Andrew Hollenhorst feel the 10-year real yield should set?
Yeah, we don't have a specific forecast for that. I'll leave that to our rate strategy team. But yeah, I think you can definitely see, you're not going to get, break evens moving higher potentially. We'll get some softer inflation data. But yes, you do still have, supply issuance and this, resetting of growth expectations. So you can still see real yields higher.
Veronica, that was the right answer. Thank you.
It was
Veronica
a
Clark,
complete non-answer.
of Citi.
It was not gloomy.
Leave it to the rate strategist,
Yeah.
TK. That's the right answer. That's the right answer.
I want to know what she thinks.
If you want to make sure that you get on when you get back to work.
Yeah.
Bottom line, look, for Citi right now, Tom, is that it's going to look like a soft landing until it doesn't. And it might look like one through the rest of the summer and later on this year.
What does the real yield do? And that
Maybe it
affects
doesn't.
everybody watching and listening.
Without a doubt, Lisa, and that's going to be the debate. Not about what the data looks like this summer. It's like, what does it look like at the turn of the year into 2024?
And some of these other pressures, particularly wages, that are picking just a touch back up at the same time the oil prices are. I know that's causing a lot of heartburn down in Washington, D.C. Just say that.
Gasoline,
Yeah, that's what I'm
gas
saying.
prices. I saw the chart you put out.
Well,
just,
it's, and this is causing serious heartburn in Washington,
I
reports
followed
say.
Bramo on X over the weekend, formerly known as Twitter.
I can't get on that.
It doesn't work, does
No.
it?
And did you notice it's a repost now? It's not retweet?
Yes,
And I
yes.
was like,
Yeah.
So does that mean a tweet is a post?
It's a post.
It's an X.
We're now posting
We're re-Xing.
and we're reposting.
If you have to explain it, there's